Kalu Aja. We do our morning spaces every 7 p.m. West African time on Saturdays. We may move it to Sundays, but for now it's on Saturdays. Here we talk about money, we talk about finance, we talk about the economy. We always want to make it personal for you. So we take those big issues, those big topics that you read about, we bring it to the space. We have a guest sometimes. I would just analyze, what does it mean for you? What does it mean for your money? How can you take advantage or how can you protect yourself from the big news and events that you hear? That's what we try to do on this space. So no buzzwords. We keep the English very, very simple so you can follow and you can implement, because we're adults, we learn by doing. So I'm always trying to tell you how you can do, just a guide. We're all educating ourselves, right? So we're just doing a guide. And guys, this is the third session of this podcast. Believe it or not, we started 2 years ago. So this is the third session. We've had 135 editions of this podcast. Believe it or not, 135. We started to record on the YouTube, but you can find the bulk of these recordings. Just search for the podcast. It's called The Way I See It, or search for my name. It's available on all platforms: Google Podcasts, Amazon Podcasts, Spotify. It's all there. Tons of great topics you can read, listen to in the comfort of your car or your home, and it will enrich you guys. So search for the podcast and do catch up, right? But for the first year, what we always do every year, we do what we call the financial health check. And this is going to be your own personal to-do for the year. And what we're trying to do is exactly what happens when you go do your medical. You go to the doctor, and you tell the doctor to check out your vitals, you take your temperature, your weight, your cholesterol, and it tells you, I think you are healthy. Oh, I think you're doing too much of this. Cut down on eating fatty foods or cut down on smoking, that sort of thing. That's what we want to do, but for your finances. And it's a personal exercise that you're going to do. That's what you're going to do for 2023. But we start off in January. We make you calculate your spending. And from that spending, we can help you create a budget. I'm not going to do it. You are going to do it at home. If you are married, I would prefer you do it together. It's a great exercise for you. Believe me, it will help you. Every time I do this exercise, the comments are always, I did not believe I spent so much money on this, on suya, on gala, on things you don't think about. Those 10 naira, that's where your money is really going to. I want to basically show you how you can do a proper budget. That's what we're calling the 2023 financial health check. So the very first thing, guys, we're going to talk about your income and your expenses. That's the first thing we're going to do, your income and your expenses. Then we're going to talk about your assets and your liabilities. With your income and your expenses, we want to help to get your savings rate. So make sure you're writing this stuff down. We want to do your income and your expenses. That's in one bucket, right? The second bucket, we're going to do your assets and your liabilities. Want to get your net worth. That's what we're trying to do, right? So our income and assets. I want to dimension those two, right? The very first thing we're doing for the first 30 days is we want you to track your income. Which means, guys, get a notebook or get an Excel sheet or get a program. There are lots of programs like Monify, like Mint. You want to get those programs and you want to track for the minimum of 30 days your total income and your total expenses. Income is broken down into two. So make sure you're writing this down, guys. Income is broken down into two. You've got your active income and you've got your passive income. So your active income is the income that you have to physically be at work to earn. So if you work for yourself, right, and you have to go to work to earn a living, that's active income. If you work for someone, if you're a stockbroker, you're a carpenter, you're a fisherman, right, you are going to work to earn a living. That's active income. The other income is passive income, which means you invested in something and that gives you income. So if you own a house, or you own a business, part ownership of a business, and they pay you dividends. That's passive income. You're not there, but you're getting the income. If you're in America, you might want to break your passive income into two, because that's how the IRS does it. In America, they will ask you to break your passive income into investment income and then other passive income. So that means that if you are earning income where you invested in a stock or a bond, that's going to be investment passive income. But the other passive income will be like maybe you own a business, you own an Uber, that's going to be something else that you mix. So it's going to be your active and your passive. You can break down passive if you want into investment passive and normal passive. But those are the two things you want to track in your income. Income is very easy to track because you get paid once a month or once a week. It just comes into your bank. You can easily track it. So that one is pretty easy for us. We know where to go to and we know where to plug it in. Remember, you're tracking corresponding periods. If you're in America, you are paid bi-weekly. So that means only your expenses bi-weekly. If you're in Nigeria, you're paid for the month. Hence, you want to track for the month. But whatever you do, you have to prorate your income to your expenses. The real exercise, guys, is going to be in your expenses. On the expenses side, guys, you want to track everything you do also according to two headers. The first expense item you want to track, make sure you write this down, is your non-discretionary expenses. This means these are expenses that we call necessary, that you have to make, irrespective of if you make money. I explain. You have to eat. Whether you make income or not, you have to eat. So feeding, food, is a non-discretionary expense. So you want to have a column for non-discretionary expense and you basically track it there. But for now, just track everything. Don't categorize. Just track your income. Just track all your expenses. Don't even categorize right now. Do it for 30 days. You can use a piece of paper. What I do personally, I have an Excel sheet, which I've broken down, right? But day to day, I have a little small black book, which I keep in my pocket, right? So if I go out, I spend with my card. So that way you have a record of what you spent for that day. So I spend with my card, but what I can't buy with my card, I write down in my book. So at the end of the day or at the end of the week, I simply go to my bank account and I detail everything I have spent for the entire week or the entire day. I take my little black book and I can get out what I spent that I couldn't use a card to spend. So I have my total expenses. I just list them all out. I don't bother to categorize at this moment. When I am done with my income for the 30 days, we will then show you guys how to categorize. This is when you then categorize all your income into active income and passive income. And remember, the passive side, you can break that passive side into two. It's going to be your investment passive and your normal passive. So you're going to have income and then three subheads: active, passive, and investment passive. On the investment side, on this expense side, you're going to have just two headers. One is going to be your non-discretionary expenses, and the other will be your discretionary expenses. So your necessary, the one you must do, even if you have no income, you must eat, you must pay rent, you must pay school fees, right? You must pay power. Those are your non-discretionary. You don't have discretion over them. You can reduce them, but you must pay for food, right? So that's going to come non-discretionary. Then when you want to go on a holiday, you want to buy a new Chelsea jersey, that's discretionary. You can choose to do that. You can choose not to do that. So you're going to have 5 separate headers: active income, passive income, and passive investment. You're then going to have non-discretionary expenses and discretionary expenses. This is what we want to see after 30 days. So the whole idea, if you already have your expenses for, say, December, or you have a way you have tracked 30 months, you can go ahead and categorize. So you simply go to your list of your total expenses, because this is where you have to do the categorization. You look at all your expenses. They then say, when I went to Mr. Biggs, was that discretionary or non-discretionary? We know it's food, but where do you categorize that food? Is it eaten in or is it eaten out? Can you cook? Because the way you categorize eating in Mr. Biggs is going to be very, very important. If you go to work and you eat out at lunch, then that is basically discretionary because you can make food at home, right? But if you can cook food at home, then you are cutting down that cost. So the point is, what you categorize determines how you build your budget. Very, very important, guys. you categorize properly. If you buy suya, that is header food, but that food is also under eating out or eating in. The food you eat at home is necessary because you are cooking that food. You have to eat at home. But do you have to eat outside? Because it costs you a lot of money and you can actually bring your own lunch with you and save money. If you can afford it, go ahead. But if you cannot, how do you categorize eating out? Is it discretionary or non-discretionary? This is the real exercise you need to do on your expenses, to break down every single expense item into discretionary and non-discretionary. That's what you want to do. Once you have broken it down, I can then give you the keys to analyze it. So that way you go back to what you have done and then you can plug it in and say, is this percentage correct? This is my target and all that. I'll give you the keys to analyze what you've done. Very simple. It's going to be an Excel table with 4 items. And all you have to do is to say your goal, guys. And if you want to speak, I can add just request to speak. If you have a question, I'll add you, right? The first thing, guys, like I said, is to detail all your expenses. That's the first thing. The second thing you're going to categorize. You categorize all those expenses into discretionary and non-discretionary. The analysis is pretty easy. When you look at those 4 boxes, what are the 4 boxes? Active income, passive income, non-discretionary, discretionary. When you look at those 4 boxes, your goal, the reason why you are working is this. You want your passive income, that passive income that is under, you want that passive income to be able to pay all your expenses, or at the minimum, to pay your non-discretionary expenses. Once your passive income can pay for your non-discretionary expenses, that means you can retire. So retirement is not an age. Retirement is when your passive income can pay for your non-discretionary expenses. So what I mean is this. Bill Gates today has got billions in the bank. What that means is that Bill Gates, his passive income, he's here in Nigeria fighting polio, but Microsoft is still working. So he has passive income from his ownership in Microsoft, right? So that passive income can pay all his expenses. He pays for his private jet, he pays for his hotel. So Bill Gates can retire. Same with you. You have a house that you live in. You own the home, you don't pay rent. You own your car, you don't have any debt. You've done your kids' education fund, you put money aside for the education, you bought your healthcare insurance, you have all that investment set up. If you do this exercise and you calculate that your total passive income from your rent, from your investment, from all that you have, right? If your total passive income is able to pay all your bills, your NEPA, your holiday, your school fees, once you reach that stage in life, that's retirement. That means you can choose to retire if you want to. So your target is to say, how near am I? That's how you calculate it. You don't calculate by your income. Because if you calculate by income, if you earn 1 million in Lagos and I earn 100,000 in Zamfara State, you will say you are richer than me. But that's not true. In Zamfara State, my expenses are lower than you in Lagos State. So I have a shorter time in Zamfara to go from 100,000 to pay my expenses. So I can retire faster and easier than you earning 1 million in Lagos. So you don't look at income as a retirement, right? You look at how near are you to your passive income paying your non-discretionary expenses. Guys, I've said a lot now. Let's take questions, and if we can at the end, I will continue with the next part of the analysis. This is just the first analysis that you want to ensure that your passive income is paying your non-discretionary expenses. That is why you are employed. You are employed so that you take active income, your salary, and you convert it to passive income, your investments. So when they tell you salary is what they pay you to forget your dreams, that's not true. Your whole idea is to take that salary and invest it. Someone's going to say, okay, but I don't make enough to invest. Then get a job or get a skill that you can make more money. So it's not an excuse, right? If you can't do this 4 box thing I'm telling you about, then you can't retire. It's that simple. If you earn money, but you can't generate passive income, then you can't retire. Passive income is the goal. Active income is what you are making right now. Even if you have your own shop, you have your shop in Onitsha, that is active income. You must convert that active income to passive income. So you invest in other things that if you are not in that shop still pays you. Samuel, what's up? Good morning or good evening. How are you doing today?
Yeah, Colin, thank you for the conversation. So I just have one quick question. So if our end goal should be that our passive income, to pay our non-discretionary expenses, what then should be the goal for our active income?
Correct. Great question. So the active income is what you control, because your active income is your job or your income. And you get that because of what you have learned in school, right? Your skills. So let's put it this way. If I'm a computer guy, I learn how to do Python, then I get active income. My goal is to convert that active income to passive income. So I'm buying my own house, or I'm buying real estate properties, I'm buying investments, I'm investing in a business. When you have a business, that's also passive income because you own the business, you own shares, just like Bill Gates owns the business. So they pay you dividends, right? So whatever active income number you want has to do with your non-discretionary expenses. Bill Gates' passive income can pay for his private jet. So you want to ask yourself, Samuel, what passive income do I want? Do I want a second home in Ghana or the Caymans where I go for holidays? If you want that, then you have to work more passive income. So it's for you to decide how much active income you want to fund your non-discretionary expenses. At the minimum, your active income should pay for your non-discretionary expenses. At the best, it should pay for all expenses. So some of the answer to your question is this. It is based on what you determine is a non-discretionary expense. That's then what you want to target as active income. Does that make sense?
Yeah, it does. It's clear. Thank you very much.
If you live in Zamfara State and your target is to have a land with a farm with your kids and a Mercedes Benz, then your expenses are lower. Hence, your active income need is going to be lower. That's the point we're making. All right, great. Thank you so much. I've got unbiased. Unbiased. Hi, how you doing? Go ahead, sir, with your question. Unbiased, you got the floor. Okay, unbiased is getting ready. Let's go to Big on Haman Mansa Hiji II. How are you, sir? Go ahead. Hello, sir. I can hear you. Go ahead and ask your question. All right, since you're getting ready, so guys, let's just continue to again. If you're just joining, we're talking about how to do your financial health check, and we talked about 4 boxes you want to create. 4 boxes. The first box is going to be your active income, which is income you make when you're going to go to work. Your second box is your passive income, which is the income you make whilst you're not at work. Your investment returns, right? Remember, if you own a business, that is passive income, but you don't have to go there. Bill Gates owns Microsoft, but he's not at Microsoft headquarters. If you own a business and you have to go there to make money, that is not passive income. If you own a business and you have to go there every day or every week to make money, that is not the passive income we're talking about. You must be able to leave that business and that business still pays you. That is passive income. Then on the expense side, you have 2 boxes as well. You have your non-discretionary expenses, your necessary expenses, then you have your discretionary expenses. And we've said your goal is to make sure that your passive income, not your active, your passive income is able to pay for, at the minimum, your non-discretionary expenses. That's your goal. If you hit that goal, that's retirement. That you have reached financial independence. Abba Boy, nice name. How are you doing, sir?
Mr. Carl, I'm doing fine. Good evening.
Good evening to you, sir. Yeah, go ahead.
I'm doing well.
Yeah, what's up, man?
I'm doing well, yeah. I'm doing well. How about you?
I'm just trying to stay alive, bro. It's a good year. It's looking very, very good. It's going to be a good one. I'm so confident that 2023 is going to be a breakthrough year. So I'm looking forward to it already, yeah.
Yes, we all pray so.
Amen.
We all pray so by the grace of God. I just joined in.
Okay.
So,
how far have you learned a few things already?
Is that?
Have you learned a few things? Are you picking up a few points already?
No, I just joined in. Yes, I pick the last things you said about passive income.
Correct.
I thought I'd get something there.
Correct. And the point I want to make again for Nigerians is that lots of Nigerians have got businesses. So you own like you're a sole proprietor, you have a shop, you have a law firm, you have a financial consultancy business. That is not passive income. I'm making a point again, unless it can give you money without you being there. Very, very important. So even if you own the business, right, you have, like Dangote owns Dangote Cement. But I don't think Dangote goes to Dangote Cement to work. He has a CEO there. Has a CEO that runs the place. It's a PLC. So for him, he can say that company can run even if I am not there. That's the aspiration. You can buy Dangote shares, and that's also passive income to you. So that's the first thing, right? That's your retirement. So the question you want to ask yourself is this: if your active income cannot pay your non-discretionary expense, that means you have what we call in medical terms, you have a disease that's going to kill you, in quote. You stop there. You stop there immediately. So when your active income cannot pay your non-discretionary expenses, there's something wrong there, and it's a big problem for you, because that means that you are working, but you can't pay your expenses. So there are two ways to fix this. You can say you want to fix the expense side, but how much can you save? If you're in Lagos, would you say you won't go on a transportation, or you will not eat? So the best way, in my view, is to try to learn a skill. And when we say learn a skill, we're not talking about going to learn Python. We're also talking about going to learn, if you're a vulcanizer, go and learn how to vulcanize maybe cars that pay you more, bigger tires, so you get more money. If you're a tailor, go and learn maybe embroidery. You want to add a skill. If you add a skill, then you can increase your active income. But for you, when you do the triage, when you look at your expenses written down, once you're active, cannot pay your non-discretionary, you stop right there. You don't even go further. You have a major problem. You have surgery, you have cancer, and you must take it out. You must take it out by increasing your income or reducing your expenses. What that means is that you are living your life on debt. You are borrowing to live your life, which is a big problem, because if they call those debt or interest rates go up, then you are stuck. So your very, 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 very first thing to say, does my active income, the one I earn from my salary or from my hustle, does it pay for my expenses? The one I have to pay, not the going to America holiday, but can I eat with what I make? If the answer is no, then guys, you want to stop right there. Go and either get a skill to increase your active income, or you look at your expenses. In most cases, in Nigeria, for instance, it's an issue of income, not really an issue of the cutting down your expenses. Because really, if you earn 1 naira in January 2022, and you earn that same 1 naira in December 2022, that income went down by 20%, because inflation was 20%. So even if you're a well-paid guy, inflation is your biggest tax. It has taken away 20% of your income. So for every 100 naira you make, you are really making, just rough numbers, right? You are really making 80 naira. But the cost of goods, look at the problem. The cost of goods have gone up by 120. So the same 100 naira you have, when it's paid to you, you get 80. But when you want to buy goods, you don't have to pay 120. Look at the gap, 80, 120. Rough calculation for you. This is why you must convert that active income to passive, which takes us to savings and investment. You can't save your way to wealth, but you cannot invest unless you save. Savings is you not spending money. So if I earn 1 naira and I don't spend it, I have saved it. I don't have to think about it. If I just don't spend that money, I have saved it. But when I take that savings and I deploy it to a specific purpose to get a specific outcome in a specific vehicle, say I take that money and I say I'm going to buy bonds to earn 5% because I want to take that money and buy a house, that's investing. So you have to save so you don't spend, then you invest that savings. That's how you are able to then take your income, your active income, and convert it to passive income. The gap in financial planning that we see is that many people have active income but do not know how to convert from the active income to the passive income. That's the problem in the financial planning space. Income, no problem. I make $1 million a month, but I'm in debt. You are in debt because you haven't learned how to convert the active to the passive. You are going from active to expenses. So when you go active to expenses, you have to fund it with more and more income, which then makes you spend more, which then gets you into debt. Guys, it's a lot I want to unpack, right? A lot I want to unpack, but I want us to do this first 30-minute exercise. This first 30-day exercise, of writing out the expenses. We're going to do this same talk February, the first week of February. We're going to have the same talk where we analyze what you've done in 30 days. So I don't know if I should plead or beg you guys, make sure you get on this. People pay for this, right? I do this as a side gig. I have a job. I'm a certified education guy. People pay me for this, right? I'm giving it to you guys at no cost, right? But I'm not going to look at your numbers. I'm going to work with you as a group, right? So people pay for this. This is what rich people pay. They go to their accountants, they go to their tax attorneys, and they do this same exercise. Yes, they add more elements. They add taxes, they add estate planning. But the basic is you look at your coming up expenses and you say, can I afford this? Then you do a deployment of assets from your active side to your passive side to pay your upcoming expenses. Then the rest you lock away so that it's not going to be taxed. You know the good thing about passive and active investments, the more you move your money to passive, the more you open up yourself to tax savings. The more you save money in your RSA, for instance, the more you buy life insurance, for instance, the more you get tax savings. So on the tax side, it's better for you to save and invest. So there's nothing bad in saving and investing. It's just the means. I get it. It's just the means to save and invest. So lots of ways we can pull the strings. How can you increase your active income? I'm going to try to give you guys a business plan that's going to come true 10 years from today in Nigeria. I'm going to give you this business plan for free. If you can run with it, run with it. 10 years from today, it's going to be a money maker. And it's going to be a business plan that if you are from the southwest, southeast, I think you will benefit more from it. And it's a business plan you're going to do in your village or in your town. It's not a Lagos business plan. So I'm building it up. Maybe this month or next month, I'll tell you guys about it. Whoever wants to run with it can run with it. It's going to be a big money maker in the next 10 years. Guaranteed money, guys. Guaranteed. But you've got to invest in it. So let's get these basics out of the way. Then we can talk to bigger things. I'm going to also bring in, like as usual, our financial guys, the stockbrokers, to talk to us about where should we invest in 2023. So we're going to get all those experts coming to tell us, hey, this is what I think is going to happen in 2023, inflation, and this is where we are putting our money aside. Maybe you guys can learn and all that. So we're going to do all that, but let's get the basics done. So guys, if you have any other questions, We spent 35 minutes. It was going to be a 1 hour space just to lay out and explain all the speeches for us guys. If you've got more questions, I will be glad to take them. I'm available here at least an hour. And again, guys, I'm not trying to plug the book, but most of what I'm telling you are in the book, right? It's free on Kindle, but it is available in Roving Heights and Amazon. Get the book, detailed step by step, right? The title of the book, Let's Talk About Your Money. It's also breaks down there. If you're a student and you want a book, send me a message. I'll give you a huge discount. I do the book to teach, right? Yeah. Samuel, how's it going so far? You still hanging in there? All right. So, if we, I don't want to.
Oh yeah, I'm still. Thank you. I'm really learning.
Yeah. I don't want to go too much to really talk and load you guys a lot of information. But if you guys do have a question, let me look at my DMs. I do get a lot on there. I'll be glad to take them. Don't think if you can't ask a question, just send me a DM. Okay, I see this one here. Let me just some very, very good question I addressed over the week. So someone asked me a question. He said, my sister is paying my house rent. She doesn't live in Nigeria. She pays my house rent. Do I include my house rent in my expenses? The answer is yes, right? The answer is yes. Why do you want to include your house rent? Because if your sister doesn't pay you tomorrow, the expense remains. You still need that house rent. Fine. So what I think you could do for accounting's sake, right? You could say put the expense there, and you could say take what your sister is paying you as income. So you could say money from my sister, put it there, expense, house, put it there. Why are you doing this way? Because that expense is not going to go away. If you don't capture that expense, if your sister stops paying you, you're going to see a big hole in that account. So if she's paying you, accountants will call it benefit in kind. But you have got to analyze and say, yes, I am paying this expense. Do it without your sister's income and see what you see. You will find out that it's not sustainable for you, right? That you are living in a house that you're not paying for based on your income. So a target for you could say, I want to at least pay my house rent by myself. I'm not saying you should reject her money, but try to have it at the back of your mind that this is an expense. Somebody else is paying it for you, right? But it's an expense. So is it any different from if your employer pays you, gives you housing? Not exactly. If your employer is paying you housing, right, and you live in Lagos and Lekki, it's very important that you have that housing expense as an expense. You put it asterisk. If you leave your job tomorrow, you still have to live somewhere. So if you say, I earn $1 million and I only spend 500,000, true, but your house is free. So you work in the Navy, you work in the Army, your house is free. If you leave the Navy or the Army, where will you live? If you say, I'm going to take my pension and build a house, then do that. Then simply say, okay, this money that I've set aside for my housing, instead of paying rent, I will start to build my own mortgage. So you can say, okay, my sister pays my rent is 500,000. I'm going to pay myself my own rent of 100,000. But instead of paying my rent, I'm going to go buy land somewhere and I'm going to start to build out a house, right? You have to capture that expense. You can't say it's free because it's not coming from your pocket. Even if it's coming from your employer, it's still an expense. I get it, it's benefit in kind. Yes, it's not accounting, but it is a real expense. So that's a good question. That's a very, very good. I want to take my time to explain. You are simply capturing it, not to change the accounting of it, but to remind yourself that that free quote unquote house actually has a cost. That's why you're doing it. It's the same question I got. Someone asked me, my partner gave me money, capital to start a business. And the person asked me, this capital is free. I'm not going to pay back this money. What should I pay interest on that money? I said, yes. Look at how you do it. You would assume and ask yourself, if I got this money from a bank, this is not the accounting. The accounting is correct. It's going to come in as capital. But ask yourself, if I had to pay interest on this loan, will this business survive? If the answer is no, That's not a business. That's a subsidy. That means your partner is subsidizing that business. That business cannot survive in the real world. So you have a shop, your partner pays the rent for that shop. So the shop is profitable. You say, yes, I'm making money, but you're really not making money, because if you factored in the rent and you then did the real profit and loss of that business, it's a loss. But I get it. Many people do this because they want their partners to do something on their own. Don't stop doing it. Do it. Don't say because you're not making profit, you won't do it. No, I'm saying recognize the accounting part, that business is not profitable. If you try to run with that business, it's not going to be profitable. And the same thing that we see when folks are working. So let's say I work in a bank in Lagos, right? But I also have a side gig. So I work in Lagos, but my side gig is I do computer consultancy. I drive my company car to work in Lagos. Then after work, I drive the company car to my side gig, right? Then I use generator that I'm paying generator allowance. I'm still dressed in my office clothes, So I'm using the same time, maybe after work, but it's a company car, the company generator allowance, and I run my side gig. And I'm making profit. I say, yay, I'm making two incomes. My bank pays me, my other company pays me. Okay, strip away the company car. Do you have a company car? If you take away that company car, or accountant will tell you to add, you apportion the cost of that company car to your business. So you give that company car a cost. Give that company car a cost. Give the company diesel a cost. Then rerun your profit and loss and ask yourself, will this company, if I was using my personal car, not the company car, would it make a profit? So many people leave work, they work in a bank or they leave work and assume they have a profitable gig. But no, it was only profitable because you used the infrastructure of your current job to operate it, right? If you no longer have the contact, you didn't do marketing, you stayed in your office, people came to you in the office, then you still said, oh, I want to do this job. You said, oh, we don't offer it, but I have a guy that offers it. So you are doing free marketing, you are using a company car to do your own business. When you leave that company, you don't have access to those marketing anymore. You have to do your own advertising spend. That is your own company car, your own company diesel, your own marketing. Will that business still make money? So I'm not saying go change your accounting. I'm saying recognize those hidden costs. Those costs are not captured when you are doing this. That's why you want to recognize them. Oh my God, I just found out that my DMs were okay. I just did this now. You're all good now. Okay, excellent. Yeah, I can see it now. I got you. Yeah, I can see your messages now. Okay, yeah. So the other guy is asking a question. So I hope I've really trashed the question about how you address what you receive, even if you don't pay for it. Other question I get a lot is that, what is miscellaneous? I want to do miscellaneous, suya, gala. I spent less than 100 naira. Guys, that is where the leaks are. If you earn 1 million, the leaks are in those 100 naira. Because you're giving 1,000 naira, 100 naira, you don't think about it. If you add it up together, it's a lot of money. And it's not money you budgeted for. You have to have a budget for it. You have to have. There are many ways to do this. You can have a dedicated card for feeding. Dedicated card and say, all my feeding is going to be on this card. I don't use cash. So that once you run out of money for that card, sorry, go and eat at home. That's being disciplined. It's called the wallet system. So you create a wallet, i.e. it could be a debit card, and you only spend from that card for that particular purpose. Then you do your own budget, you allocate money, and you stick with that budget. It allows you to hit your goals faster. So don't do miscellaneous. Don't say, if you give money to your girlfriend, write it there, money for my girlfriend, and track how much you have spent on your girlfriend for 1 year. You will be shocked. You will be. Money, if I gave my boyfriend money, write it there. I gave police 100 naira, write it there. So you see how much you give to police in the end of the year. Very important, right? So another question I get is this: I pay rent annually, but you're asking to track our budget for the month. What should I do? Great question. Again, thanks for the messages, right? You have to take your annual expenses and you take it to the same time you are calculating your income. So if you pay food daily, right? In Nigeria, we do monthly. If you pay rent annually, you divide that rent by 12 and you say you are paying rent for the month. So that for the 30 days we're going to work, you want to get your 30-day money. That's what you want to do. The same way if they pay you housing allowance once, you divide that by 12 and you get your exact housing allowance. The same way if you get shares, a company is going to pay you share end of the month. You want to assume that they paid you those shares for the 12 months. Then you divide. So if Nestle paid you 100 naira shares once in the year, right? That's your passive income. You can divide it by 12 and say, okay, this is how much I got. Remember, what we are trying to target is this. We want to get your active income. I want to compare it to your non-discretionary expenses. And if you're just joining, we just said that the reason why you were doing this financial independence is simple. It is when your passive income can pay your non-discretionary expenses. That is financial independence. That's when you can retire. So that means that it is not income that makes you financially independent. It is when your passive income, not income, passive income can pay your necessary expenses. That's independence. And I give the example of a guy in Zamfara. A farmer in Zamfara has expenses of 500,000 naira a year. Let's say because his house doesn't pay rent. So let's say example 500,000 naira a year is his total expenses for the whole year. A guy in Lagos is earning 1 million a month, so he makes 10 million a year. Who is richer? It's not the income guy making 10 million, because the income guy makes 10 million, the bank guy, but his expenses are 9 million. The Zamfara guy makes 500,000, his expenses are 100,000. So you can see that the Zamfara guy can hit financial independence faster, quicker, and more sustainable than the Lagos guy. So Lagos guys always have that impression, I'm making more money, so I am richer than the guys in the village. Not true. Nigeria is a very, very funny society. Expenses is the key. If you have a lower non-discretionary expenses, then you can hit retirement faster. That's why in America, you see them when they are young, they go to New York, to Florida, to California and work. Once they are old and retire, they move to Florida, they move to Texas, they move to Tennessee, lower cost cities. So they can use the same pension, but they move to a different town where the income is reduced. Onyeka, what's up, man? You've been waiting. Thank you so much, sir. What's your question, sir?
Good evening, sir.
How you doing?
Yeah, fine, sir. Thank you for the whole lectures, but I've been finding out to send you a DM, and I've been asking all over and all over.
DM is working now. Go ahead.
Like, send you a message.
Sure.
Okay. And secondly, is there a kind of template for this recording your financial expenses, like a template that you can recommend? I tried monthly. I tried one, the app that you recommended, but it was too technical for me. So is there a kind of Excel template that I can use?
I have an Excel template. If there's an Excel expert right out there that I can give a template and they can make it available, but I can't reply everyone. If it's an Excel expert that can send me them and say, I can do Excel, I can give it to you, you can do it, and you can send everyone as a link. Send me a DM. So I have an Excel template. I want to give it to people. So you take it from me, you remove all the links, you just make it people can use it. So send me a DM, I'll send to you, you format it, then I will link it on my Twitter page and people can use. So if you're an Excel guy, I'm not a geek. If you think you can do it, just send me a DM. I can't send, because when I say people send me messages and I can't respond to those messages. So if you, just the Excel guy, if you're an Excel guy, I'll give you the link, you format it, send it back to me, then I'll attach on my Twitter page and people. So Onyeka, but you don't have to get complicated, Onyeka. Create 2 columns on Excel. Income, expenses, track everything. Nothing complicated. Right now, we're doing the 30-day tracking. We will now do in February the allocate. I'll tell you guys the allocations and the analysis. of that allocation. I've already said to give you something non-discretionary, discretionary, but for now, 30 days tracking, track everything, income, expenses, right? If you want to use an app, there's something called Monify, Monefy. Monify does good expense tracker. I'll just go online and just say expense tracker apps. There are many of them, but I find that those apps on your phone is the fastest way I see that. The best way I see is this: use a card and spend. So with your card, you can record everything you have spent, right? Then get a notebook. Writing is very, very quick. Just small notebook with paper. If you spend money on anything that you can use a card, quickly write it there. Then at the end of the day, go to your Excel sheet and put it all there. That's the best way I do it. It might work for you and that, but that's the way I find that it's a lot faster to do, right? So Excel sheet, notepad, use your card. If you use cash, you can't track cash. Does that work for you, sir?
Yes, sir.
Okay.
Yes, sir.
So do this one. February 1st week, we're going to come back and do the categorization. Now, you guys have had all your expenses. Then I'll not tell you guys, we categorize like this, categorize. And if you're an Excel guy, send me them. Just say, hey, I'm an Excel guy. Send me the Excel. It's free. I'm not going to charge. Just send to me so you can do the work for people and you can take it. If you can do that, I'll appreciate that. All right, Anyeka, thank you so much. If you let me first clear this. I've got Joshua. Yeah, go ahead. You're good.
The first question. I've been trying to send you a DM.
DMs are working. My DMs are. Why can't you say I'm reading DMs all day? I can read my DMs right. This is from Michael. Michael is saying, will this exercise be needed for someone with no passive income at the moment who are just getting their active income? Michael, I am doing this because of you. So, guys, if you are listening to this podcast, the reason why I'm doing that, I want you to think about your income as active and passive. I want you to have a plan to say, I'm going to transfer money from my active to my passive. Start small. Say 1%. So any income you make 100 naira, you're going to take 1 naira to your passive. The type of passive, we'll talk about that all through the year. But for now, have an account, call it passive income. Say any income I make, it doesn't matter what, any income I make, 1% minimum, I'm going to put it in passive income. Because it is not income that makes you rich. I've given you the example. It is passive income. Bill Gates, Elon Musk, the guy that owns LMVH, they are not rich because they have income. They are rich because their assets generate passive income. Elon Musk is rich because Tesla generates passive income for him. He can go to the bank and borrow on those assets. That's the passive income. He doesn't have to be there. He's in Twitter, but Tesla is still working. You get the point. If you have a business that you have to go to, that's not passive income. You have to own the shares of that business. So even if you leave Tesla to Twitter, Tesla is still working and paying you something. They pay him income. So that's passive income. So you convert your active to passive. Then you take your passive and you want to compare how much of your non-discretionary expenses can my passive pay for. If today it is 0.1, then give yourself a target. Say next year, I want 1% of my total non-discretionary expenses to come from my passive income. That's a good target, 1%, which means that if I spend 100 naira, I want to spend that 99 from my active income and 1%, 1 naira from my passive income. That's a good target. You get it? So start small. Think 4 boxes: active, passive, non-discretionary, discretionary. That's what you want to do. So Michael, that's your answer. Onyeka, you are asking a question. DMs are open. Send me a DM, I can read it. But if you just want to send me a DM, yeah, it's open.
Okay, sir. Thank you, sir.
Thank you. I've got Joshua. Joshua, you've got the floor. Go ahead, sir. Joshua.
Okay, good evening, Mr. Kalu. Thank you very much for this topic. You've actually addressed some of the things I wanted to ask. For a quick one, you've talked about earning passively. I joined a moment ago. Okay, I'd like to confirm. Investing. What would you recommend as a number of years to just keep putting your money into passive income. Okay, and we do know that life do happen, and sometimes you're tempted to like break your investment. Okay, so can you just give the best way to avoid this? Okay, that you're consistent with your passive income, and maybe when you're faced with challenges, you don't have to go back there to just take out of what you've saved. Thank you very much.
That's a great question, Joshua. And what you're asking is this: you're saying, how can I actually do this budget thing so that because I don't have a budget and I don't want to come and break it? That's a great question. So what you want to do first of all is to agree on understand that you have to save and you have to invest, because when you are younger, the advantage is the age that you have. Your age, not the interest rate, is the most important factor in investing. So if you're a young person listening to me, you have the advantage of time. If you look at the calculation that is used for compound interest, it is raised over time, not raised over interest. So Einstein says compound interest is the eighth wonder of the world, because the longer you keep the money in there, then the more it makes money for you. So to answer your question specifically, Joshua, I would say if you want to build a portfolio, not a single asset, but a portfolio of assets. And that asset will be three basic things. Number one is cash. Number two is going to be what we call fixed income. Number three is what we call variable income. So there's cash, there's fixed income, then there's variable income. Cash is cash. So you are keeping cash or near cash, right? Number two is the fixed income. Those are things that you are guaranteed of the return, like bonds. So if you buy a bond, your principal will not increase. The income you make is on the principal. So when you buy a bond, they are paying you on your principal. Your principal will never increase, right? Then we have the last one, variable income. You're buying like shares. When you buy shares, your principal can increase, but it can also decrease. Your fixed income, your principal cannot increase, but it cannot decrease. In variable income like shares, your principal can increase and decrease, but the return is in that variable income. Shares over time, over a long period of time, have the advantage of being able to beat inflation because they can expand. So when inflation happens, shares expand, quote unquote, not all, but they can expand. Fixed income cannot expand. So when inflation happens, they fall. So if you're a young guy of 25 years old, you want to build a portfolio, look at how they say it in my industry. Use the rule of 100. Take your age minus 100. The larger figure you put in variable income. So if you are 25, 100 less 25 is what? 75. So put 75 of your income in variable income. Put 25 in cash and fixed income. Then you say, tell us, if I need money, if I fall sick, I go to my cash. I don't break my investment. So I go to my cash. But long term, I want to put the bulk of my savings in variable income. The older you get, you are going to go more from variable to fixed. So if I'm going towards 60 years old, I'm selling my shares and I'm buying more fixed income because I can't take more risk. So the answer is you want to do a portfolio, say 10% cash, maybe 25% fixed income, and then the rest is going to be variable income. If you are younger, do more variable income. It will go up, it will come down, but the trend is up. The trend is up. This year, the Nigerian stock market did 19.98%. 19.98%. That means that it nearly beat inflation. Inflation in Nigeria is 21%. 21. If you put money in the safest investment in Nigeria, which is the federal government bond or the federal government bill, over 1 year, you get anywhere from 6 to 8%. It is safe. Your principal will not expand, but you are guaranteed 6 to 8%. But if you bought shares, when I mean 19.9%, I mean you bought all the shares in the Nigerian Stock Exchange. If you bought all the shares, your return will be 19.98, which means some will give you 100%, some will give you minus 50%. So your average is going to be 19.98%. That return is very near inflation. So as a younger person, if you did that, you see this year you make 19, next year you make minus 2, next year you make 40. The trend is your friend. It's up. Same thing in America, same thing in Nigeria. So I would say if you're a young Nigerian, try to diversify into American stocks as well, because you can today. When I was growing up, we couldn't buy American stocks. Now on your phone in Nigeria, you can buy Tesla, you can buy American stocks, buy ETFs. Just write it down, ETFs. So you go Google what ETFs are, buy ETFs. Buy ETFs for America, buy ETFs in Nigeria. That's where you want to invest, right? As a younger person, you put more of your money in variable and less of your money in fixed, and you ride the wave. You want to transit from that active to passive. We'll talk more about this, Joshua, over this year. We'll tell you where, what type of variable, how you should select it. And I've written tons of articles. Google my name, Kalu Aja, do Nairametrics. You see tons of articles I've written. They are there for free. If you want it in a book format, buy the book. It's also there, right? Thanks, Joshua. I have a great question.
Thank you very much.
You're welcome. I have a great question from a lady called Miriam. Miriam is asking, how do you separate the wife's personal expenses from that given to her partner for upkeep? So, Miriam, the answer is that, is he giving you the money for yourself or for the upkeep of the house? So it's your, and I'm not trying to be sexist, sorry guys, but in Africa, the men give the women money for the upkeep. But do they pay the wife a salary? Now, I always argue that the housewife is doing two jobs. She's the CEO, she's the CFO, she's the operations director, but she's unpaid. So the men give her money to say, buy food for the house, but they don't give her a salary for that job. They're going to say, why should I give my wife a salary? Well, because she's working the same way they pay you a salary. But let's digress, right? So, Miriam, is he giving you the money to take care of the household or for yourself? Thank you for replying. If you reply, then I can ask my next question. So, Miriam, I'm going to wait for your answer. Once you reply, I can then answer you. The bubbles are still going. Miriam, type faster. Okay, I'm just waiting for Miriam to respond so that I can. Okay, so if he's giving you the money, right, for your personal self, then that is your not for her personal money, just money for the house. The wife has her own money and she wants to track. Okay, if it's money for the house, we're not tracking that money. That money for the house is our expenses. That is our non-discretionary and our discretionary. So money for the house is money that is the expenses. So like I said at the beginning, it's best you do this as a household, right? So the husband and the wife together will then do this exercise. If you want to do it personally, that means that you will track your own personal money. So your expenses will be your apportioned expenses. You say, okay, if I live in a house with my wife and 4 kids, what is my own share of the expense in that house? It's a bit more difficult for you to do, but you can apportion and say divide by 3 or divide by 4. You can do that if you want to. So money for the house is not your personal money, but personal money is money that you then take and then invest. So you have to first of all save it, so you can then invest it to convert it from active to passive. The concept of saving and investing is how you convert active income to passive income. Hope that makes sense, right? And I see you replying. I'm going to wait for your reply and then we'll continue. Let's go back to our chat. We've got Dr. Com. I've got $B2. How are you doing, sir? Women add their own personal money most times. That's where the commission comes in. Let me just finish with Miriam. Miriam, right? You should, if you have a household, do a household budget. Very important. If you have a household, do a household budget. That means I'm going to say, this is the budget for the house. Then do your own personal budget. Separate it. Don't, because the household is the business budget, then your personal budget. So if she has her own personal money, that's her personal money. Both of you should bring your personal money and say, we're going to pay NEPA. Who will pay NEPA? Is it going to be both of us, or will I pay NEPA and you pay household and you pay rent? Agree who is going to share the fees. Agree it. Your wife earns money, you earn money. Sit down and agree. Who will pay for this? Who will pay for this? Who will pay for this? If you have agreed on apportion those expenses, then you can do this exercise with your own apportioned expenses. That's what I will say on that. Dr. Com, sorry about that. You can go ahead and speak, sir. $B2, you got the floor, sir.
Okay. Good evening, hello, Aja.
How you doing, sir?
To find out. I've been hearing about this ETF you've been talking about, and most times I always used to think it's something that happens more or less in America and other advanced economies. The ETFs, how do I get to buy it in the Nigerian stock exchange houses? That's what I wanted to.
Okay, so Nigeria. So let me just do a quick explanation on ETF. ETF simply means exchange traded fund. It's the same as a mutual fund, or in Nigeria we call it a unit trust scheme. It's almost the same, no difference. The key difference is this: if you notice, if you have a unit trust, let's say you buy a unit trust scheme, like maybe you buy the FCMB money markets fund. Those are unit trust schemes, right? If you buy them, you get the price at the end of the day. So if you want to buy from FCMB, you have to go to FCMB and ask them for the price. They'll give you the price at the end of the day because they have to trade, close their books, and give you a price, the net asset value price. That's how all unit trusts work in Nigeria and America and all over the world at the end of the day. So the exchange traded fund, the key difference is this. During the day, you can buy and sell them. So they are exchange traded. That's what the name is, exchange traded. So it's the same setup, but you buy and sell during the day. Now, let me give an example of an exchange traded fund in America. There's something called the VTI. I'm not recommending, I am just giving you this as an example. VTI. V there just means Vanguard. So Vanguard is the guy that sets it up, right? They're a massive company. If I buy the VTI, what I'm buying is an index that tracks the US market. So I'm buying immediately nearly 4,500 stocks, including Microsoft, Tesla, Google. Just at once I buy the VTI, I'm buying those stocks. With my $10, I buy those stocks, I diversify at a cheaper cost. Very easy way for me to enter the US market. What about Nigeria? There are many Nigerian ETFs. If I want to buy the one that listed abroad, I think it's called I'm going to get the name and post for it. It's the NGX 30. Let me get the exact name. I'm just going to Google Nigerian. You can do the same thing, Nigerian ETF. I just Googled Nigerian ETF. I hit enter. It's the MSCI Nigeria ETF. That's what it's called. MSCI Nigeria. The ticker is NGE. Let me try to post it on the Twitter page for you. The ticker is NGE. So if you buy that NGE ETF, what are you buying? You are buying, I think, the top 30 stocks in Nigeria. That's what you're buying. And let me give you what you're buying. If you you're buying Dangote, you're buying Guarantee, Zenith, Nestle, FPN, MTN, you are buying Nigerian Naira, you are buying Fidelity, EcoBank, and Nigerian breweries. That's what you're buying. So you're also buying Lafarge, Flour Mills, UBA, Stanbic, FCMB, Access, Dangote Sugar, Transcorp, UAC, Sterling Bank, Unilever. That's what you are buying once you buy that Nigerian. It's called the NGE. And I'm going to post it on this tweet so you can see exactly what I'm saying. So ETFs allow you, what did they allow you to diversify at a cheaper cost? That's what you're basically doing. Nothing magical about them. So you can get them. And someone is asking me, where can I buy ETFs from? All those apps have them. All those, I'm just going to list the ones that are approved by SEC. Chaka is approved by SEC. Cowrywise is approved by SEC. They have them. If you put VTI on Cowrywise, it pops up. If you have this other one, NG also, it comes up as well. So DCOM, I've put the link to the Nigerian one. VTI, just go to Google, just Google VTI. Same, just say VTI ETF. Nothing magical. It comes up there. VTI ETF. It pops up. You see it there. So you can just buy. I'm going to put it up for you as well. VTI. I'm going to grab it there and I'm going to put it on the handle again for you. So guys, I'm not recommending these stocks. I'm simply saying these are examples of exchange traded funds. They're an easy way for you to diversify and get into a portfolio of stocks. Because you can buy these things with like $10, $25, $1, and you're in. Right? So you don't have to wait till you become a billionaire before you invest in stocks. So I put both. So Dicom, I put both the VTI and the Nigerian one for you up there, right? Does that work for you? Excellent. Thanks a lot. All right. You're welcome. Let me go back to DMs. Okay, we've got let me get Chido. Chido, you got the floor. Go ahead, sir. Why aren't the ladies asking questions? Oh my God! Please, if you're a lady, just hands up. I'll add you real quick, please. I'm partial to the ladies because the ladies are now getting their investment groove on. MTN shares. The ladies in Nigeria buy a huge percentage or the major investors in the MTN shares. So they've gotten their groove on. And it's just going to be better because women, they've done the studies, women are better investors than men, but they don't know why. They say it's because they don't take risks, but that's also a negative because if you don't take risks, then you don't make the rewards. But women tend to take less risks, hence they tend to be better investors. That's just what I'm hearing. But that's if you Google it, you see the reports out there. Chido, what's up? You've got the floor. Oh, I see Chido. Chido, you've got the floor. Go ahead, sir. Chido, yeah, go ahead.
Good evening, sir.
How you doing?
Thank you very much for the lecture tonight. It's a very nice one. I've learned a lot. Yes. But I have a question that I want to ask. Can you hear me?
Yes, I can.
Can you hear me?
I can hear you, sir.
Okay. My question is this. Is it good for someone to invest, but then you can take a loan and make that kind of investment? Like say you want to buy a landed property, then you want to start a business, you take a loan and then you invest. Then the company or can be taking it from your salary. So what advice do you have for me?
Yeah, it's a good question that we get all the time. What you're asking is that should you use leverage? So when you take debt, that's called leverage. You're asking, should I use leverage? The answer is it depends. That's the answer. It depends. It depends on what are you buying. If you go back to our box, if you notice, we say we've only talked about income and assets. Let me talk about assets and liabilities. The same thing let's just do a quick talk on that to answer your question. When we are going to track our assets and our liabilities, we have to have two boxes. We're going to have income generating assets and non-income generating assets. We'll also have interest bearing liabilities and non-interest bearing liabilities. So 4 boxes. One is the income, the assets that give you income. The other is the assets that don't give you income. The other is the liabilities you pay interest on. The other is the liabilities you don't pay interest on. So it's just 4 boxes. Now, what are they? If I own my own home, that's an asset to me. But my house does not pay me interest. So that's an asset that does not bear interest. It's an asset to me. I own the house, but I don't earn any money from it. So it's reducing my expenses, but it's not paying me any money. So that's an asset that does not pay me income. If I own a share of Dangote Cement, Dangote Cement pays me dividend. So that's an asset that pays me a dividend. So you see, asset, one pays me, one does not pay me, but they're both assets. Go to the liability side. If my mom gives me a loan to start a business, and she says, don't pay me interest, just give me equity. What it means is that my mom is an owner, an investor in my business. I'm not paying her interest, but I owe her. So that's a liability that I'm not paying interest on. But if I go to a bank and I borrow money from the bank, I am owing the bank. So that's a liability I am paying interest on. So 4 boxes: asset, liability. So your question is asking me, if I want to borrow money from a bank, that means you are going to the interest-bearing liability. You have to match it. If you borrow money from a bank and you're going to pay interest, you have to invest in an asset that will give you income. Hear what I said again. If you are borrowing from a bank to do anything, you have to invest in an asset that will give you money. Which means the guy is asking me a question. This is Lawansin. Lawansin is saying, it's the same question you're asking. Lawansin is saying, because of inflation, should I buy a car? And then because of inflation, when inflation happens, it destroys paper money, but the value of assets go up. What this means is that I am able to hold more value in an asset than in paper currency. So if I bought a car last year, inflation was 20%, money will lose value by 20%, but my car's value may go up because the value of the asset, even with depreciation, will go up because the naira has lost value, so the asset will go up, right? So you want to ask yourself, if I'm borrowing money, will the return from that investment be able to pay back my loan? That's what you want to ask. That's the first question. Number two, will the returns allow me to save interest in the future? So if I am borrowing money to build my personal house, the returns are going to be that I save money in the future. So when I'm older, I'm not paying the house rent. So yes, but it's location, location, location. You can't borrow money in Lagos to go build a house in your village that doesn't pay you interest. Why? Because you can't service that loan. You are taking an interest-bearing liability to buy a non-income bearing asset. It's not going to work. You should take a loan to build a house in Lagos, make income from the house in Lagos, and then go and build your house in the village. If you take the loan that pays you interest to build the house in your village, there's no income to pay back the bank. So you take the loan from your bank, build a commercial venture, then use your income from that commercial venture to build a house in the village because it's non-interest bearing. Did I answer that question for you? Does that make sense to you, sir? Chido, did I?
Yes.
Okay, excellent. And that also answers, thank you. Also, Lawrence, that's the point I'm making, Lawrence. If you want to buy a car in Nigeria, you want to ask yourself, right now, are you spending more money without a car? And will a car reduce money for you? So if you don't have a car in Lagos, you buy a car, it saves you money, Abi. If the car is not going to save you money, it's a liability. If you buy a car, accountants say it's an asset. But if the asset is taking more money from you, it's a liability. If you have a phone, the latest Apple phone, that thing costs nearly $1,000. $1,000 in Nigeria is nearly 700,000 naira. Is that phone an asset or a liability? If I'm doing Instagram, I take pictures, I post my Instagram, all that kind of stuff, then that phone is an asset. Because that phone, I'm using the nice features, the camera, the stuff to do my Instagram to make money. So it's an asset. But if I'm just carrying around a 700,000 naira phone to tweet, then you want to ask yourself, is it really an asset? I'm not saying you don't have a phone, but the same iPhone 7 can do the same tweet, right? So to invest that amount of money from your active towards that non-discretionary expense, you want to pause. That's the whole idea what we're talking about, right? Buy the phone from your passive income. Buy the phone from your passive income. Make your active income, invest your active income, the returns from your passive income, buy yourself the iPhone 11. But if you take active income and you buy the iPhone 11, then you are killing capital. You've taken the active straight to expenses. So you've killed it. Any money that goes from active to expenses dies. But if it goes from active to passive, it lives, it has children. You will kill money because you have to eat. So anytime you spend money from your active to feed yourself, you've killed that money, but you have to stay alive, right? So that's why we separate expenses into discretionary and non-discretionary expenses. Any expense you make that is discretionary, you've killed it. Ask yourself a question. If I go for a holiday Is it a necessary expense or a luxury? If you're a CEO or you are working in Lagos or you are under stress, a holiday is very important to your ability to make money going forward. So you want to go for your holiday. It's not a luxury. It is the way you will sharpen your soul and refresh your mind to make more money. So your holiday is actually a non-discretionary expense. You want to refresh and rest and then come back to make more money. The question is, where are you going for that holiday? Are you going to Togo or Greece? That's where your budget comes into play. If you earn ₦1 million in your active, should you spend 50% going to Greece islands for a nice holiday? Or you can go to Togo or Benin or Rwanda for another holiday. So it's not the holiday, it's how much you are apportioning for the holiday. So Frank, hope that makes sense to you. If you're buying a car, ask yourself, will it save me money? If it's going to save you money, go ahead and buy it. But what type of car? Are you going to buy a Range Rover that's going to cost you a lot of money to maintain? Or just buy a Toyota that you can maintain, just go on? That's really the answer for you. So it's not the car, it's not the problem. It's what type of car and how are you paying for that car. Hey, we've got St. John Duo. Guys, about 10 minutes, we're going to call it off, and then we're going. Hey, John, you've got the floor. Go ahead, sir.
Evening, Kalu. Thanks for this. I'm a very huge fan of the information that you talk about when you host these rooms.
Thank you, sir.
Yeah, I also am very passionate about the financial education in Nigeria. I haven't been back to Nigeria in a really, really long time, not for forces I can't control, but we'll be coming back very soon. I just have 3 things I want to talk about. I do believe that we all know more about financial education. And so someone like me, I went to school here in America, but then I started working at banks. And when I started working at banks, I realized that a lot of the way we interact with money in Nigeria is not the way we should be doing it, So listening to you talk about all these different financial instruments and sort of educating people is very promising. I think what else? So the second one I'm going to go into is the stocks thing is very, very key. I think what Kalu said in the beginning, everyone should really take note and just do a little research on your own, looking into what stocks you can buy. And the fact that we all have mobile phones now, you can actually go into these marketplaces. You can just create an account, go into these marketplaces, and it doesn't matter what you start with. You don't need to start with $100. You can start with 50. And if you really, really want to play it safe, like Kalu said, the ETF is the best you can do, because what the ETF does is that exactly what he said, it diversifies your portfolio for you, when you're still buying a single volume of that particular financial instrument. And the thing is, since that financial instrument is a combination of all these other different stocks, when any of them rise, you are sure your money is rising. So look at ETFs in industries that you are familiar with, ETFs in industries that the products of those industries, you interact with those products maybe every week, every month, every now and then, but you are sure that these products are things that you use, people use, and a lot of people are going to use. I think that's the best way to get into it. And then if you're looking for data as to, if you want to get specific and start going into you want to buy a particular company stock, you want to buy a particular industries instrument, you should look into these outlets that have financial news, giving you the actual data. Finance is a little confusing because we're giving names to all these different financial instruments, and it kind of confuses people. But it's very easy, guys. It's the same way they name grains, Gary, and all these things. The same way it's the same thing. You just need to educate yourself a little bit about it. I've been lucky to work in the financial industry, so I've been able to learn so much. I started investing about 4 years ago, and it's the amount of financial freedom that comes from just this, investing in stocks. I'm not even doing any of the accounting and this thing, but just from investing in stocks, the amount that have been able to get back. Sometimes it puzzles me how we're not big into stock markets in Nigeria.
I got you.
You know, so like people just like look for like the earning data, like, and the thing is that there's this. By the time you do research, 1 year, 2 years, you'll start to see the trend. You'll start to see that, okay, at the end of the year, you know, retail people, their stock always go up because Christmas is coming and people will buy. People are going to buy gifts. People are going to buy all these things. So you will start to see signals and you'll start to be able to understand what this stock is and start making smarter investments. Just to round things up, I don't want to waste your time, Carlo. I really want you to keep educating people, but I'm very technical. I studied engineering and computer science in school, and I've worked with like about 3 different companies now in America. So, Carlo, I really like, someone came up here and was asking for, you know, an app or something that can help them sort of manage their finances. I DM'd you, Carlo, that you can send me the Excel. I can clean it and send it back to you.
Okay.
But I also want to work with you if you're interested in developing tools that people can use, because you are Nigeria, so you know the kind of expenses people have. You know, or like there's like, because you are there, you have that information. So if you build a particular tool or product, or you help assist me in building a particular tool or product, I'm sure it would. The average like Nigerian will be able to relate to it. Like the other guy said when he came up, he said he downloaded an app, but it was too technical for him. You know, so if we can make a thing that people can easily just pick up, and it already has like presets of what Nigerians, you know, spend the money on, where most of the money is going. You mentioned something. Oh, when you give police money. Oh, when you give your girlfriend money. You know, all those things are cultural things. Here, like in different parts of the world, it might not be part of the main expenses of people there, but in Nigeria it is. So your personal finances is supposed to be customized for you. And so, Kalu, like I said, I would love to keep in touch. If you want to help, or if you have some information, or if you need like any technical assistance in any of the things you're doing, please, I'm here to help. I have more than enough time to, help you work on these things.
Yeah, I'll take you. I'll take you up on that, right? So I actually have an Excel sheet that is built for Nigeria, and what we've done is that we use the Nigerian things, generator, all that stuff, food, eating out, school fees. We have all that in Nigeria, exactly. RSA, we have those things in there. And what we also did with that Excel sheet, we linked it up. So once you put in your income, it calculates automatically for you your cash flow. It does for you automatically your assets and your liabilities. So if you come in and you say, I earn 100 million naira, I spend money on food, it will calculate your net assets, it will calculate your ratios for you. So you can't just play with it. You can plug it in and you see the results and you see what you're doing wrong. So you have it. So when you go talk to a financial analyst, you can say, this is my problem. I want to solve this problem. So we actually have it built. That's why I said, I can't send to everyone, but I'm going to work with you. Like you said, when I send it to you, you do a cleanup, make it, user friendly. Then I'll attach it back on Twitter, and anyone that wants to can download it and run with it. Yeah, it's going to be free. We're not going to charge. If someone wants to sponsor and put a link, I don't know if I should do sponsorship, but it will be free for users. So I'll work with you. Yeah, after the space, we'll talk. I'll clean out that Excel and send to you, and then we can send out to people. So it's already pre-done. It's already pre-done.
Okay.
It's got your income, your expenses, your net.
And my last question I want to ask. I'm an engineer from school, but I became very aware and educated about financials since I started work, and I've only worked in the financial industry. So to be honest, I still love engineering. It's still something I'm passionate about, but I'm realizing that this financial literacy is a necessity, honestly. So I want to ask a question quickly about economies. Can a country prosper without the stock market of that country prospering? Is it even possible?
Yes, it's possible. Look at but you have to give you a contextual answer. What does the stock market do? The stock market allows the people to discover prices That's all it is. The stock market is no different from the market that sells Gary in Lagos. There's no difference. If you have Gary in Abia State, you have cassava in Abia State, and you want to sell it, who would you sell it to? I want to buy Gary in Lagos. You're a farmer in Abia State. You want to sell, I want to buy. We don't know ourselves. So that's inefficiency. And because there's inefficiency, the price of Gary in Lagos is very high. But the price of cassava in Abia is very cheap. So what the market should do is that the guy in Abia State will log into the market and say, I want to sell cassava. The guy in Lagos will log in and say, I want to buy Gary. Then both of them are able to agree on a market-determined price. Because that price is available to everybody, a farmer in Kogi will say, no, I have cheaper Gary than the guy in Abia. So he will put his own bid in there. What happens to the price of Gary? It falls. Then the guy from Kogi, from Anambra will say, no, I even have cheaper cassava. He put in his own bid there. So the price falls. What are we talking about? Efficiency. Because there's efficiency and market knowledge, we know the sellers, we know the buyers. There's no hoarding, there's no price hikes. Because if you hike your price of cassava in Abia State, the Kogi guy will supply. So prices fall. That's the price discovery we're talking about. Then the farmer in Abia can sell his cassava today, get money today, and plant and deliver in 8 months' time. That's the markets for you. So what the stock markets do for the country is allows the allocation of capital when prices have been discovered. That's what it's doing. So when you see the US market, if you're a startup in the US, even if you don't go to New York Stock Exchange or the NASDAQ, there are other small markets you can go and trade your ideas to. You can buy and sell your very risky stock to, and investors can get in. The PE market, the angel market, it's all there. If you want to take the risk, you go invest there. So I get capital. That's why in America, you have only in America has got Google, Microsoft, Facebook, Snapchat. Why is it only America that have these guys? You know why? Because you can get risk capital in America. You can't get it in Europe. They are too conservative. They are too regulatory. In America, when you are bankrupt, it's actually a sign that you took risks and you are a good entrepreneur. In Nigeria and Europe, if you're bankrupt, it means you're a thief. That's how we look at it, right? So Americans are more risk takers. They go to the stock market, they invest. An American starts a company because he wants to do an IPO. How many Nigerian companies have done an IPO since you were born? Kennedy Lichiku, I grew up riding his buses. He was the greyhound of West Africa. New buses, great business. He died. What happened? Many companies you can list. There's the only one company I know in Nigeria that has survived from, say, the 1900s. I think it's Alabuku that has survived from that long. Every other company, the family owns them. They are doing very, very well. The patriarch dies. They go out of business. So that's what the stock market does. It's not magic, but the culture of the place has got to align with the stock market.
With the stock. Mm-hmm. So I have a quick follow-up. Everything you say, I feel like I can even this can go on for forever. So let me just end it with this one. So in the financial area, I personally work with high frequency trading systems. So I help them build out the infrastructure that is used to do all the high frequency trading during the day in banks. So one thing I agree with you that the stock market is for pricing, and everybody would have, every bank would have its own marketplace, dark pool, and then every NYC, they have one in Chicago, they have one in Washington, they have one in London, Tokyo. Although they don't have in America, because every time we program for all regions except Africa. Sorry, they don't have in Africa. We program for all regions except Africa, it's unfortunate. So, but when it comes to the high frequency trading, because in my mind now, the stock market, especially in developed countries, the stock market in developed countries is now, it has become just like algorithms, optimizing the price, right? So if the algorithms are the ones optimizing the price and everybody is trading against the algorithms optimizing the price, do you think that, for instance, a stock market in a country like Nigeria, we can grow to compete with these people?
Yes.
Because
I hear you. Let's talk more, but let me just answer your question, right? The Nigerian stock market was booming in 1961. 1961, there was no phone. 1961, the same companies there, some are still there today. The point I'm making is this: you don't need classy phones, computers for it to boom. If there's money to be made, people will go there. What is happening today is this: there's a gap in education in Nigeria. If when I do these spaces, I said to do all this thing about financial education because because I'm in the financial space, I assumed people understood these things. People don't. You ask me what's inflation, they don't know. You ask me what is stock, they don't know. So if you don't know, you can't invest. The guys in 1961 were educated. So they understood going to the market to raise capital. Look at the companies in 1961. They were Nigerians that were controlling that market. 1961, you had Onitsha, you had Lagos, you had which other places have a stock market, and they were booming. Today, people tell you, oh, it's scam, I don't understand it. They want to do Bitcoin, or they want to do bring 10 people and make 100 million. That's because there's a lack of education in the market. The more schools teach people, the more you are plugged in, the more you understand investing. Say, let's talk after this. Let me get some guys to go in. Right? Let's talk after this. And we'll definitely talk on all that. I appreciate you saying that. We'll set that still up for you. Hey, Brent, how you doing?
I'm good. Thank you so much for this very informative space. I have a question. So a lot of people like to talk about real estate, ETF, mutual funds, and all sorts of investment tools. But a lot of people also don't talk about life insurance as a form of investment. So I wanted to hear your opinion regarding life insurance as an investment tool.
True. Great question again, right? Great question. So when we had, I believe, was the last space in 2022, and I laid out how you should invest. I gave you steps like how you do it 1, 2, 3, 4, 5. Let me do a summary again for you, right? Before you start to invest, the number one thing you want to do, emergency fund. You want to have 3 months of your non-discretionary asset. That's the number one thing you do, emergency fund. The number two thing you do is life insurance. Technically, you can never insure your life. What you are insuring is the loss of income should you lose your life. Hence, if I am a worker and I have a wife and I have 2 kids and I earn $1 million a year, if that income goes away, who takes care of my wife and 2 kids? Who pays the rent and the school fees? Hence, I go to an insurance company and I say, I want to insure, I calculate my budget, right? And I say, every year, my family spends 10 million a year, every year. So I buy life insurance for 30 million. That's the cover, right? Some are short for 30 million. What's the premium? I'm a young guy, I'm below 30, I'm healthy. I don't travel by air. So they don't give me a low premium, they tell me to pay 10,000 a year. So with life insurance, you pay 10,000 a month. And you instantly have 30 million assets. It's the only investment on earth where you can pay something today and get access to assets immediately. So if you buy life insurance in January 1st and something happens, something happens January 2nd, you instantly have got the assets you bought for, even if you don't pay anything. So life insurance protects your assets, not your life. It protects the loss of income. So once you have dependents, you must, I'm not saying you should, you must insure your income. And there are smart ways of doing this. Do your expenses, get the expenses, do ×3 and buy. That's why the retirement savings account that you open, the government mandated that your employer must give you 3 times life cover. So once you have an RSA, you must have 3 times life cover as part of that retirement savings account. It's in the law, it's there. But you personally can do yours as well. A good trick is to say, if you buy a mortgage, if you buy a house with a mortgage, you instantly buy insurance on the value of the mortgage. What does that mean? That means if I take 25 million and I buy a house, and I'm only paying the mortgage every year, so I'm owing 25 million, I buy insurance, life insurance for 25 million. So if anything happens to me, the insurance company pays my mortgage, my family has the house rent-free for life. I give that insurance company to a trustee. So I buy insurance company, the life insurance, I go to a trustee and I say, hey, trustee, you'll be my corporate trustee. If I pass away, the insurance company will pay you. You pay the bank. So my family has that house 100%. You can do the exact same thing with education. You go to a trustee and say, if I pass away, my kid must go to this school, where they're educated. If the money should be in, give it to my charity or to my church or to my football club. You can do that. So that's how you use life insurance. It's not insurance. No, that those guys will have a briefcase. You want to use it to protect an income, an asset, or to plan for an eventuality. That's how you use it, Brent. Does that make sense?
Yes, thank you so much.
Excellent. Good job. All right. So we've got Omar with me. Thanks. That is the first lady. You see, one lady's asking me a question, I take my time. Or more. Vincent. Hi, Vincent. What's up? You got the floor, sir.
Good evening. Thank you.
How you doing?
First of all, I want to say well done for the work you are doing.
Thank you, sir. I appreciate you saying
that. Just like you have, this other caller, was his name, has pointed out. And as you have also mentioned regarding the in the 60s and all of that, companies that were booming on the floor of the Nigerian Stock Exchange and all of that, the awareness that is basically that is lacking. And a way to even address what you are also saying is how foreign managers all bring their funds to invest in the market, whereas our own locals are all shying away or are running away from our market.
Good point.
And this also explains why Nigerians fall victims of a lot of these pyramid schemes, MMM, this, all that, because they are all shying away from where they could have been making a lot of money. So your enlightenment and continuous education of the Nigerian populace is actually a great one. It is one thing for them to listen to what you are saying. And it's another thing for them to actually take their advice and take action and do what is necessary. Well done.
Thank you, sir.
You'll be mentioning to them forms of them investing in ETF and all of that. Maybe which is great, but for the young ones who have the capacity to take risk at this early age, them just easily contacting a stockbroking firm and opening a stockbroking account, it can actually enable them to buy some of this. They don't even need to do so much reading, so much understanding, so much this thing. Just ask the firm, which of the stocks can I buy?
I would
these brokers will recommend names.
No, I would disagree. I would disagree a lot. That's why the problem is, because you shouldn't ask your broker what to buy. If you ask a car salesman, should you buy a car? What will he tell you? He'll tell you, of course, you should buy a car. If you ask a barber, should I cut my hair? Of course, you should cut your hair, because when you cut your hair, you pay him. You have to have the broad understanding. Remember, what you just call him now is stock broker. His job is to brokerage that transaction. If you want to ask anyone a question, you go to a fiduciary. You go to a fiduciary that is charging you a fee to tell you what to do, not a broker. A fiduciary is going to listen to you and then tell you, based on what you've said, you should do this. A stockbroker will sell you because he makes a commission. I get where you're coming from. You are correct. But try to understand what you want to do. Then you execute via the broker. If you don't know what you're doing, pay. Listen, there are some ladies on Twitter that do financial education. Tolu, Ronke, I know them. I post them all the time. Gather yourself. They charge money. Gather yourself. 50, pay the money, invite them to come and talk to you during lunch. They will come and speak to you. You learn. If you want to pay yourself, it's expensive, but get them, bring them together and say, oh, we are in this club, come and talk to us. They will come. They will charge you a fee. You ask them questions because they're not brokers. So they will tell you what to do. Then you can also compare with your own research. Then you go do it. So be very careful about asking a broker. Don't ask an insurance broker, do you need insurance? They'll tell you, yes, you need insurance. But if you go to a financial planner, or you go to a fiduciary, or even a lawyer, and you ask him, and you say, yes, this is what you should do, then you can then go do a brokerage. Does that make sense, sir? Just to clarify.
Yes. It makes
all right.
A lot of sense. But that's also taking that
all right.
You're right.
All right.
But my take is a good broker should have been able to advise you on certain names you should invest in the market.
I hear you.
In case you don't have the potential or the financial strength to go and pay a fiduciary, you just want to start something small. It won't be out of place to even start with them. Those firms that enables you to open an account for free and allows you to start your account.
I hear you, but
as you can.
I hear you, but I don't agree. So at a good point, let them get others to speak. I hear you, sir. Thank you so much.
Thank you so much. Well done as well. I give the mic. Thank you.
Thank you. All right, we got Emmanuel Noel Fulurusha. But let me just answer this. There's a guy asking me on DM. He's saying, is it advisable to take a 20 million naira office cooperative loan at 19% interest to invest in the Vanguard ETF? The quick answer is no. Why? Because it's 19%, bro. That means you have to make at least 50% to make profit. Why you don't take a loan to invest in shares, or invest in shares from your active income. Let it grow. Do it slowly over time. Sell your car. Maybe you want to take some money and invest in shares. I agree. But taking a loan at 20%, see, if you take a loan at 25%, in 4 years, you've paid back the principal. So you are paying the company back what they gave you. If it's 25%, this is almost 20%. So the quick answer to this is do not take a loan at 19% to buy shares. It's too expensive. The UK guys, the US guys you are seeing that take loans are taking loans at 1-2%. And the US stock market does 6 to 8% a year on the average. So you can't take 19% interest rate to chase a stock market that's going to give you 19% return. So I would say no. If you have passive income, maybe you have all kind of land, you have something like that, you can sell and invest. That's a different proposition. But don't take loan at 19% to invest in any stock market. It's too tight. You have to make double that to make money for yourself. So you're just making money for the bank and all that. Right. So that's the quick answer to you. I don't call your name, but that's the quick answer to you, sir. Thank you so much. Hey, Emmanuel, you've got the floor, Emmanuel.
All right. Good evening.
How you doing?
I'm very well, thank you. I just want to appreciate you for this wonderful session. Before now, I must be sincere to you. I really don't know much about this subject we're discussing tonight, but it's more like an eye-opener for me, and it's something that I would really want to know more about. This week, I was discussing with somebody. I'm an agricultural engineer. I'm into automated poultry installations and irrigation setup and all. So I have a project I'm working on this year. So I was talking to somebody for funding. All right. So when I now gave him my figures and all, this project is about crop production. So when I gave him my figure and when he got to profit sharing, actually I wasn't looking too much. I wasn't looking for too much, or I'm not looking for too much in this project. But my target is just 25 to 30% annual return. So when we got to a point where he asked about the profit sharing, And I told him, said, no, Emmanuel, this is what you are offering is too ridiculous. He can choose to, he's not in Nigeria, he's based in US, but I know he's passionate about agriculture. He has reached out to me on some projects with respect to agriculture. So when I was now discussing that with him, I said, what I'm offering is too ridiculous. He can choose to invest his money into stocks in the US, and at the end of the day, he would be fine. So I was now wondering that when I joined this session and you talked about this ETF and all, I was now wondering that can ETF be that profitable to give 20-25% annual profit annual return? So I really don't know. I just wanted to throw more light.
So guys, if you notice, right, I don't quote any numbers. I don't recommend. I'm not asking to go buy anything. There's no recommendation being done here. Don't buy anything without talking to your advisor or getting a proper education on the topic. But look at the return in America. This year was negative. Over 20 years, it's about, I would say about 20% over 20 years. You can buy a particular investment and make 100% or lose 100%. Past performance is not a guarantee of future performance. The point is, it's not guaranteed. I give you the example of there are two types of investments on earth, just two types. There's what we call the fixed income. Those are things like bonds. When you buy a bond, your principal would never expand. You won't lose the principal, but it will never grow. You only make interest on the principal. So if you buy a bond, a CD, fixed deposit, that's what's happening. Based on the user, you can never ever grow your principal. As long as the issuer is good, you get your principal back. But when you buy shares, your capital can expand and can also reduce. So you get more returns with equities, but you get that more risk, what we call volatility. So your question is, you can't compare one to one. You can't compare a different asset class to another different asset class. You can't compare houses to stocks. You can't compare bonds to houses. What you do is you compare the yield. So if it's getting 28%, what did he invest? That's his yield. So you wanted to compare yield across asset classes. But I wouldn't say, if it's not investing in you, get a different investor. You don't compare yourself to PE. It's high risk, it's high returns. I don't know what you're doing, but sell your own particular returns, right? Vis-a-vis the perceived risk that you are offering. What is the risk of him buying you? What is the risk of him buying the ETF, right? Would you give him back principal? What about taxation? All those things. But don't try to compare on return. When you do on return, that's you're comparing a car to an orange. It might not make sense. Let's get Habib, guys. Guys, we're going to show them about 7 minutes, right? So about 2 hours just listening and learning together. So by the time of the hour, we'll just shut down. If you guys have more questions, I'll take them. But yeah, let's just see if we can shut it down. Hey, Mr. Habib, you've got the floor, sir. Udo, I'm coming to you.
Okay,
yeah, Habib,
okay, thank you. Well, I heard all of the conversations and it's so much interesting. And let me thank all of you, and then for your kind contributions, and then for enlightening us and the things that has to do with finance. And then we're really glad to have you people. And thank you so much. My question is this: for instance, you have you take a loan. I think you take a loan and in a bank of at 80% interest rate. Mm-hmm. So and then you buy a sharehold and in a company, and then what is actually is going to take for you to claim that particular loan and then repay that particular loan, and then for you to make a profit on it in a just like 3 to 5 years, and then the interest rate of the limitation of the rate the rate is somewhere around 5 years.
Yeah. So let me just, Habib, I that's a good question for me to chew on, right? But let me say this, right? Once you have a high interest rate, the only saving grace for you is if you can extend the term. If you can extend the term to 15, 20 years, maybe it makes sense. But once it starts to tell you interest rate of 20%, double digit, 20%, 25%, almost that thing is already doomed to fail, because you are going to pay, you have to make 50% to even pay your own working capital before you even pay that loan. So let's say you have a contract to execute, you have an LPO, and they say we're going to pay you, you pay us interest of 50%. Okay, you do short term, you buy orange juice, supply to Shell, Shell pays you, you pay back the bank 50%. That's okay, it's short term, you are in and out. But if you're doing a term loan, you want to borrow at 25% to build a house or a factory, and you're going to pay back in 3 to 5 years, that's already, you are already failing. Look at it this way. Every business will fail without the CEO's direction. And it fails because your expenses are fixed, but your income is not fixed. So once you start a business today, you already owe taxes. You already own diesel. You already owe salaries, but your income is not owed to you. You have to go get that income. So if you add this income of 25% or 20% bank loan to a business, you have to double that bank loan to first of all pay the bank loan and pay salaries. It's too much. So look for other cheaper finances. There are lots of ways you can raise capital without borrowing. You can factor your inventory. You can raise equity. You can do LPO financing. You can go and borrow money from your cooperative. You can use your assets as collateral. There are many ways, but borrowing from a bank, banks are not set up to borrow you money, right? To do all this building long-term things. That's not how they are set up. Banks in America will lend you money, then sell that loan to people that actually package that loan to a bond for 25 years. In Nigeria, we don't have that long-term market. So when the banks lend you money, they retain that money in their balance sheet. So they're looking for five years because nobody in Nigeria gives them deposits for more than 5 years. So the summary of what I'm saying is that be very careful with high interest loans and short duration. That's a bad loan on the face of it. If at least they give you 15 years, you can say, okay, the monthly repayments reduce a bit. Maybe you can try to survive. But if they're giving you pay 25% for 3 years, run away. Run away from that loan. It's doomed to fail. Unless you are importing diesel to sell. And even at that, what's your margin? Do you know how many people, there's a popular billionaire in Nigeria that lost all his money, quote unquote, because his ships were on the sea and interest rates went up. Billionaire, talkers of us. So interest rates can kill you if you don't hedge it and all that kind of stuff. So with loans, I had a chart posted once, I tried to look for it, of how you can finance your business. You finance based on what you are doing. If you are doing short term, you do a line. If you are doing in and out, you can do a credit card, right? But if you're doing a term loan, you do a long-term project, doing a term loan. For Nigeria, you say, okay, dollar term loan is better, but look at exchange rate. Look at what happened to the First Bank guys. They were borrowing in dollars to pay back in naira. That's a killer. So be very careful about that, Habib. Yeah? Be very, very careful about those kind of loans. We don't have mortgage in Nigeria. Most of this mortgage in Nigeria is bank loan to buy a house. That's not a mortgage. You can't give someone a 5-year mortgage. That's not a mortgage. So be very careful. Come and take mortgage at 20%. Take your savings and buy the land. Build it.
Thank you so much.
You're
Thank
welcome.
you so much. Thank you. Thank you so much. Thank you.
Yeah. Let's get the Sultan, Elijah Sultan Ogumosi. How are you doing, sir? Sultan, you got the floor.
Good evening. My name. I've been listening to this space for a while now, and I really appreciate what you're doing for everybody. I have always sought for financial information and education because it helps with a lot of freedom. So the first thing, though, I've asked the question is, how do I get your book? I'm not in Nigeria at the moment. How I think I would do better with a soft copy. How do I get your book? What other avenues do you teach to help us build on our financial education? Because we went to science classes and we could not have any form of information on it or education on our finances. That is why you see most medical doctors and nurses in the country are broke. And to escape these things, we are searching for this kind of information. So how do I get your book? What other books do you advise us to read? How do you help? How do you think we can plan and get out of the rat race of earning and of dwelling on active income, like you have stated earlier. And what other advices do you have for us?
These questions you're asking is why I'm doing this space, right? So let me just answer a few questions for you. So how can you get the book? The book is available on Amazon. So just go to Amazon. The title of the book is Let's Talk About Your Money. It's pinned. So let's talk about your money. Get it on Amazon. They'll deliver to you. It's available right there. Number two, education. Financial education is something you have to go and get. It's not taught in schools. I know most schools in the West just start teaching it. And when we say financial education, we're not talking about learning how to go and buy stocks on margin. We're talking about basic stuff. Do you know that if I teach a child what APR means and how to get a good credit score, that child is almost guaranteed to do better than you, no matter his income? Just teaching a child how to get a good credit score. In America, there are 3 numbers that matter to you in life. Number 1 is your social security number. It matters a lot in America, number 1. Number 2 is your zip code. Where do you live? Where you live determines the school you go to. And so it's also the same in the UK. So if you live in a particular zip code, you go to a particular school. Simply by going to that school, you are guaranteed a particular job. That's why America is all about where do you live. It's not really racism, it's money. The third thing that is important in America is your credit score. It's rigged. If you have a higher credit score, you can borrow at a lower rate. You cannot have a good credit score unless you borrow. Hence, they want you to go borrow. So there's a way you can rig the system to get a good credit score. I'm answering your question, maybe. So the point I'm making is that you have to understand money to know how to use it. The way you learn is to basically, now you've got YouTube, you've got Twitter. Just go to YouTube and type financial education. You'll see tons of videos, tons of stuff you can read, listen on your headphones, Audible, can get it done. So I personally, there's a hashtag I have, hashtag FinPlanBooks. I've curated books there on financial planning that you can go in there and read. Lots of excellent books. Books like The Richest Man in Babylon. You read that book, that's really all you need. The Richest Man in Babylon. Simple book, simple language. You read that book, you imbibe what it's teaching, you are set for life. But do hashtag FIN, F-I-N, plan books, FINPLAN books. You see tons of books there curated over the years. I just put in there for you, right? So you can do that. So you have to educate yourself. Buy books, read, immerse yourself. Anything you decide to study for 2 hours a day or 6 hours a week, over a 6 months period, you will become an expert. Trust me. Get headphones, get books, dedicate 2 hours. You are during break, put your headphones, listen to a financial book, watch Bloomberg, watch Fox Business News, watch all these channels, understand the language we are talking about, do YouTube, watch those videos on YouTube. You understand what it's talking about. If the doctors that you're talking about, they can name the second team in Arsenal, not the first team. They can name the second team in Arsenal and tell you the positions to play. Why? Because they are interested in sports. So if you're interested in money, you would learn about money. And it's basic. What is APR? What is FICO? If you don't know these things, you are swimming in the shark with guys that know these things more than you and they'll be better than you. Why should you buy a house in the US? I wrote an article, it's still up there. How an immigrant can buy a house in 36 months. I give you step by step how you use the system and you buy a house in the US. Why do you want to buy a house in the US? Because home ownership in the US is a pathway to wealth. That's how the whites did it. So you copy them, you don't complain. You copy exactly what they've done, then you do it. So the end point is education enlightens and allows you grow. That's really it. If you don't study it, you can't get better. Last point, what we know today in biology, what they teach a 5-year-old or a guy in class 5 biology is what professors of medicine in the year 1700s knew. So think about that. That what a class 5 biology guy today knows, It's what a professor of medicine in the year 1700 knew. The point is this: what you can know today in finance is more than what even Warren Buffett. If Warren Buffett is 25, what you know today, you know more than him when he was 25. He couldn't get stock prices. You can sit down today and get the balance sheet of any listed company on earth in 5 seconds on your phone. Any balance sheet of any listed company you can get on your phone in 5 minutes. So there's no excuse, right? I got you. On the chat, guys, Leo, I see you, Leo. On this particular space, I've given you links on what an ETF is. If you want to invest, I chose 2 articles and I posted on this particular tweet. If you're a Christian, you want to invest according to quote unquote Christian ideals. You want to invest, maybe you want to pay tithes, you want to invest only in quote unquote non-sin companies. I shared an article of ETFs run by a company that is Christian that wants to give you options where as a Christian you can invest in Christian themed investments as an ETF, bonds and shares. The ETF is here on this channel. Look for it. If you're a Muslim, you want to invest according to the tenets of Islam. Are these stocks haram? I also posted for you an article I did on how you look at investment and find out if they pass the test. I am quoting authorities in Islamic finance and the tests that they have done to show you if you want to buy an airline, for instance, and the airline does not sell alcohol, but the airline is borrowing money to buy fuel. Should you buy that airline or not? I posted the article there. The point I chose those to show you that ETF is not about just making money. It's about the lifestyle, right? You want to invest according to your lifestyle. We're not investing just to make money, but we're investing also to complement how we live our life. If you're an environmentalist, you want to invest like that, right? If you like a particular country, you want to go buy a particular share in that particular country. So you're doing targeted diversification. And it's also a good way for you to understand the world around you. So this much, I took your license and I did a lot. I talked a lot, but I hope you picked some few points from my answer. So Leo Africanos, I just answered you on the ETFs, what it means. I put a chart in there for you. So if you go on this space, look at this, what I've shared, you see an article I did on ETFs versus mutual funds. It explains what ETFs are. They are called exchange-traded funds. You can Google it and you can learn a lot about it. Eric is asking me a question. Eric, I'm going to answer your question. He's asking, can I change dollars to Naira to invest in Nigeria Stock Exchange, considering the Naira exchange rate? So it's a great question. Naira today is, let's just say it's 720, right? If I have $1 in America, and I invest my $1 in US stock market, maybe I buy an index fund, average over 10 years, that return has been the best performing asset class in the entire world. The US stock market index over a 10, 20-year period has been the best performing asset class in the entire world if investing in an ETF. What's the second best performing asset class in the entire world? US real estate. So US equities number 1, US real estate number 2. Again, I'm going to post this on this chart so you can see where I'm getting my figures from to show you number 1, number 2. Nigeria in 2020 was the best performing stock market in the entire world. That was because of Dangote Cement, the best in the entire world. I think this year we are number 4 in the entire world. So the point is Nigeria stock market does do well, and the American market consistently over time also does do well. So your question is really not a question of returns. What your question is really saying is that what will be the exchange rate? Because when you take your dollars and you change it to Naira, you now have Naira risk. If you invest in Nigeria in Naira last year, you would have made 19% in the US stock market. If you made 19% on your Naira, if you try to buy dollar, you brought in your dollar at 400. Now you have to buy your dollar at 700. You see the wahala? You make the profit in Naira, but you can't take it out because once you go back from dollar to Naira, you're in trouble. So the way the smart guys are doing today is to say they bring in dollars, they invest in the stock market, But they don't take out Naira. They don't buy Naira. They buy a commodity. That's what Julius Berger is doing. They bring in dollar, they build a road, they get paid Naira. They take that Naira, they go and buy cashew nut. Because when you export cashew nut to Vietnam, you get dollars. That's how they're doing it. Other guys are doing bringing in dollar, they go and buy Nigerian stocks, then they go and buy that new gold ETF, make dollar and take it back out. There is a dollar exchange market in Nigeria where you can buy a dollar forward. Eric, I'm talking to you, right? But it doesn't really work. There's not a lot of liquidity in that market. So the way to do it, if you have dollar and you can absorb the exchange rates, you can take that dollar into Nigeria and Naira. Think about where you can invest that return in Naira. Maybe buy a land or buy a property and keep it here in Nigeria until the exchange rate stabilizes. Otherwise, you bring the dollar in, true, you will make your profit, but to take it out is the wahala. So you might also say, okay, I'll export Gary to Canada and make my money. Excellent. But anything you can buy locally in Nigeria, you can buy many things in Nigeria locally and sell abroad. Many things. You can buy commodities, you can buy, take it and sell abroad. Talk to an export guy, they will show you many things. We brought an export guy here 3 times and they make a lot of money. He exports yams and all that. So that's how you want to do this export game. If you bring Naira, you make the profit in Naira and you can convert to dollars at a price that makes you a profit, then it's a waste of time, right? Hey, Mr. Odo, what's up? Odo Jackson.
Hey, good evening, Carlos. Thank you for all of the great education you give us. So quickly, I'd like to know what kind of advice you have for the 40-year-old, because I've heard you talk about the 25-year-old a lot and how age is their biggest asset. So if you're in your 40s or your early 40s or late 30s, what kind of advice would you have? Would it be similar to the 25-year-old? What does it look like?
Great question. So when we do the lifestyle planning, so I'm not giving you advice. I'm not on this Twitter space. I'm not a financial planner. I'm not an advisor guy. I'm just educating. So quick disclaimer there. So this is not advice, right? We're just talking. All right. So when we do the lifestyle planning and financial planning, what we try to do is to say, what is your age? Because your age is the one risk factor you cannot avoid. If you are getting older, that means your ability to get active income decreases. You can't go out to the farm or to the office with the same vigor as a 25-year-old will. Also, your compounding periods are less. Remember, the formula for compounding is over time, not over interest, which means that as you are older, number one, your active income space is collapsing, and number two, your compounding period is collapsing. So if you lose 1 million when you are 25 years old, you can catch it up by simply waiting and investing. But if you lose 1 million when you are 45, it's harder because you don't have the same compounding periods to catch up. So you have more inherent risk simply because of your age, and there's nothing you can do about it. So what do we then do? We tell you that when you are investing, you do a greater proportion of your assets in fixed income. Remember we said the 100-year rule, you take 100 minus your age. So if I was 25 years old minus 100, that's 75% in variable income. But if I'm 40 years old, if I do 100 minus 40, that's only 60% in variable income. If I'm 60, 100 minus 6, that's only 40% in variable income. You see, that 100-year rule is one way you can look at it. But the overall general theme is that you're taking less risks by investing in more fixed return instruments. So you are doing more of bonds. Even if you are buying stocks, you are buying dividend-paying stocks because at that age, your goal has income. A 25-year-old's goal is asset appreciation. He wants to buy Tesla so that Tesla can go to $1,000 because he has no money. A 25-year-old guy has time but no money. A 40-year-old guy has got money but no time. So 2 different objectives, right? He's trying to buy cheap stocks that over time will become bigger stocks. But you are buying value stocks that are already big but at a lower price. So he's buying growth stocks, you are buying value stocks. You are doing more of fixed income, he is doing more of variable income. You are doing more of insurance, he is doing less of insurance because he's a healthy guy, so he pays less for insurance. So it's the same principle, but the allocations differ. If you get my book, there are almost 2 chapters on allocating. And allocation is said to be one of the greatest things or the greatest inputs to if you make money investing. If you do the wrong allocation, you're going to have a problem. What I mean is if you are 65 years old and you are investing like a 25-year-old, it's going to be a problem. Because if the stock markets go down when you're about to retire, what do you do? What do? You have to sell at a low market so you have less money for retirement. See, I mean, this week I was talking to a guy that his family had relocated to Canada in 2021. So he stayed back in Nigeria in 2022 to sell off his assets, close down this. They have a house, they have land, sell everything down. Then he was going to leave for Canada November, December, this last year, 2022. He has pension account and all that. So when he calculated his money in February, their family had about 48 million. So they were going to sell the house, pay the loan off, then take the excess cash, sell their shares, close down their RSA. The net amount of money they were going to get as of February was 48 million. So he did all that he was finally able to do everything, sell everything down and get the total cash. I believe that was in October. When he did his calculation, the money in dollars could have given them a down payment for a house in Canada when they converted from Naira to dollars. When he sold his property and everything today, so he did it from October to say December 2022, dollars had chopped everything. The exchange rate had chopped everything. So the money they got in dollars, they couldn't buy the house in Canada. They couldn't do anything with it. It was just money, just cash, maybe like $15,000. It's money, but it's nothing. But in October, in March, that money was nearly $50,000 in dollar terms. So the point of it is that imagine if that guy was retiring today and he had invested in stocks and all that, he'll get $15,000. But if he was a younger guy, it doesn't matter to him. He can still stay because the dollar rate will still change tomorrow. So when you are older, you have to understand you have shorter time, less compounding periods, less time to earn. So you've lost the advantage of time. Sorry, if you're listening to this space and you're above 45 and you didn't invest, there's nothing you can do about it. You've lost that advantage of time. If you're a younger person on this space and you're not investing, we should flog you, number one. But number two, don't lose the advantage of time. Time is what makes your money grow, not the interest. If you take 2 brothers over a 30-year period, you give them the same interest rate, 8%, whatever interest, give them the same interest rate. The younger brother, they're the same age, but one brother starts to invest 10 years before his other brother. If one brother starts to invest 10 years before his other brother, if the other brother doubles the investment his younger brother made, the guy that invested 10 years before will have more money than the guy that invested later, but invested twice the money. It's maths. It's not it's maths because it's over time. So the younger brother's money had more time in the market than the older brother's double money had less time in the market. So if you're younger, invest, stay constant. If you are older, you've lost the advantage of time. So consolidate, start to get your stuff in order, all that kind of stuff. Sorry, we're old. What can we do, man? Does that answer your question?
Absolutely. Thank you so much.
So don't lose hope.
No. I mean, you did mention something. You said the older guy is supposed to have more cash.
Correct.
And less time. So I think the question would be, where do I put my money? Yeah, I mean, I totally get you.
I get you. So that answer, I won't give you directly here, but because you have more cash, you can take more opportunities, right? So the older guy can do more MTN than the younger guy. So if MTN turns out to be a blockbuster company, I can buy more shares than the younger guy. That's where I have my advantage of the younger guy. The younger guy would only buy maybe 10,000, 100,000 worth of MTN. So he's buying it over time. Remember, guys, when I invest 10,000 10 years before you, if you invest 10 million, you don't make more money than me. Don't say because it's 10 million. No, it doesn't work that way. It's the yield. The yield of the 10,000 is more than your yield. Don't look at the 10 million and say it's 10 million, it's 10,000. No, the 10,000 has a higher yield because it invests at a lower price than you, right? So you can do more of those targeted. You can buy land in Lekki and sell. He can't do that because he has no cash. He has time. So if you are very smart, you can use your cash savings and go into investments in and out. You can buy and sell. He can't buy and sell. He has no money. So when I see all this quote unquote, I'm not being disrespectful. When I see these kids on Twitter saying they are doing trading currency, they are doing pips, I wonder, is it the same currency we are trading? To trade currencies, you need minimum $15 million. Why? Because there's no gap, there's no arbitrage now. What's the difference between $1 and €1? It's 4 pips. You are never going to see dollar or euro change by 1 or 2. You see that maybe when there's a war or when the UK guy doesn't get elected. But on a normal day, why would there be a $1 difference between dollar and euro? So why would a kid in Nigeria with 10,000 naira say, I'm doing currency? What are you trading currency? There is no rate. There is nothing there. They are doing gambling. So they buy it, and then if the thing works, and that day currency fell, they make money. That's what they are doing. They're not trading currency. To trade currency, you need 15, not naira, $15 million. Then you take leverage. So when they make 2 cents, they multiply their 2 cents by 1 billion in leverage. That's how they make the profit. So the younger guys have got the cash to trade. They got to do time, but you have the cash to trade. So you can import cocoa, you can buy a house in Lekki. They can't do it. So they're just kids. We are the older boys. We can do the big ones. But they have that. So they can sit still and make money. We can't. Make sense?
Yeah, absolutely. Thank you so much.
All right, Udo, thanks. Leslie, let's close the shop with you, Leslie. So thanks, guys. I'm not going to look at the tweets. If we have more messages, otherwise we're going to close. We'll start with Leslie. You've got the floor. Go ahead, sir.
Yeah. Mr. Carlo, this is one of the most amazing space, locally I've joined. Highly inspiring and interesting.
Thank you, sir.
In fact, your position on when to invest and why not to have invested is quite apt. Some time ago, one of my employees got me one of your books, and highly interesting, and in fact, you're cerebral, from all fronts. I just want to add to what you've just said. Why you invest early. Although the higher the risk, the higher the yield.
Leslie, can I pause you there? Yeah. Just pause your thought. That's the correct. So I get what you're saying, right? But the higher the risk does not translate to return. Just to make that point clear, right? Okay. Without risk, you cannot make returns.
Yeah.
So you read that Bible story, right? Where the guy said he gave the 3 guys the talents. He gave one guy talents, 10, 5, and 1. That's an NBA story. It's not a Bible story. It's an NBA story. So yeah, it's an NBA story. So the 5 talents guy invested in something. He made profit. The other guy invested, but the one guy, you know why the guy was angry with him? He said, "You didn't invest it. You could have simply taken risk and you can put it in the bank." So you can't make returns without making risk. But if you take risk, it does not automatically generate returns. So higher risk does not mean higher return. But without higher risk, you cannot make higher return. I want to just make that point clear. I'll explain. You cannot make higher returns without higher risk. But higher risk does not mean higher returns. Just make that point clear. All right, go ahead, Leslie, please. You are saying something very
important. I've tried to, try to kind of boast those who above 40 or 40.
Oh, okay.
Because it's the kind of cast for. I'm not past the time.
Oh my God! No. I'm over 40, and the math is interesting. The math say that let's take it outside. Why are white people richer than black people? Simple question. Because white people invested long before black people. The answer could be blacks because they were slaves, they didn't invest. I agree, but whites invested before black people. That's why whites are richer. The same thing in Nigeria. The richest, I'm trying not to be tribal, so I don't enter trouble. But if you look at the middle class that has the highest and richest middle class in Nigeria today, you can trace them to the middle class that invested in the Nigerian Stock Exchange in 1961. Go back to 1961 and ask yourself who owned those shares. Those shares are still there. John Holds, UAC, they are still there today. Who owned those companies in 1961 that were it was then called the Lagos Stock Exchange? Who owned those shares? The same people that own those shares today are the guys that today are the richest middle class in Nigeria. You can't run away from it. Look at Japa. You see Japa? This Japa thing that's happening is going to change Nigeria. It's going to change the demographics of Nigeria. They're going to find families that did not go through the traditional Nigerian way of getting money, where in Nigeria to make money as a family, either you have a family name or you go to an education. But what Japa is doing is to say anybody, you can be a plumber and you go to Canada and you become a millionaire in Naira term. You send for your family comes to Canada, you guys instantly become middle class in Nigeria. So they come back to Nigeria, you will then see certain people, in quote, that were not supposed to be middle class will now become middle class. And that's when you have this cultural financial change in Nigeria. So you give it 15 years, you will see a change in the demographics. Not just, you will see certain cities that were backwater cities will suddenly become Ikoyi. They will suddenly become Ikoyi. So I was going to give you guys a business idea. I don't want to give it out too early, but I'm going to give you guys a business. I'm going to do a space. I'm going to just, if you come, I will say it and I will not record it so no one can quote me. I will give you guys this business idea. It's a 10-year business idea. It's guaranteed to make you profit. It's something you have to go and invest in. Guaranteed you make the money back. But Nigeria, it's just the reality of it. If you didn't invest 10 years ago, you won't be rich today unless you join politics. That's the only way you can do it. Leslie, so if you are below 40, don't be downcast. You have more assets.
No. For me, I'm a big time investor.
Excellent. Yeah. And 40 in the years now, you know, when we were 40, our parents were 40, they were old. Right now, if you are 40 years old, you are 20 years old.
Yeah. I had the two sides of the coin. I started early and I lost money, You know, usually my mom used to tell me those days, if you made your first money as a young man by maybe below 20 and you lost it, it means that you have future. So we lost our first 1 million 20 years ago.
Wow, you lost it in 20. I mean, God, I used to buy. Let me tell you how I lost my first million. I was sitting on my own. I used to work in an investment bank. Some guys came and said, "Oh, they've just invented credit cards in Nigeria." That was the first time credit cards went to Nigeria. I won't call them name of the bank. So they gave us credit card because they wanted us to use it so our friends will see us using it and they'll go and get the bank. So we got a credit card. These guys gave me 1 million naira credit on my card in Nigeria. What year was this? This was 2003. 1 million naira on the credit card. So what did we do? We were in an investment bank. So we took the credit card and we started buying shares. So what do? We'll buy shares that have issued bonus. The trick is this. I'm giving you guys free bonus. If in Nigeria, when they issue bonus shares, If the share is 100 naira, when the bonus is declared, the share price will fall by the exact amount of the bonus anywhere in the world. The share price will fall by the exact price of the bonus. So they do a 1-for-1 share. That means if you have one share, you get one bonus share. If the share price is 100, the share price will fall to 50. So what happens? People will see Nestle stock. They don't follow the market. They see Nestle stock, right? They buy it, so they every day see Nestle stock 100 naira, 110, 150. Then they open the ad and see Nestle stock at 50 naira. Nestle, what do you think happens? They think 50 naira means that the share has fallen in price to 50. So they start to buy it at 50. It's the exact same 50 naira share, is the exact same 100 naira share. Because it's a bonus, the price of 50 is adjusted from 100 to 50, but people don't know this. So they see 50, they think it has fallen in price, they start to buy. So they'll buy back to 100. So we will simply take a credit card and buy those bonus shares because the price is going to go up. So you buy the share, you sell the share, then you keep the bonus and you make 100%. That's what we're doing. And it was easy money. But that particular year, we bought that share, the bonus got stuck in the registrar. They didn't give us our share certificate. So that's how the share price went up and came back down. Base of credit card hit us. So that's how we lost our so you have to be very careful. Most of the things I say is experience. I'm not reading from a book. Credit cards are weapons of mass destruction, right?
It's experience.
Yeah, be very careful with credit cards.
It's like the cost price.
All right, Leslie, thank you so much. Let's wind this down. Now, I'm going to wind down with the last question by a guy called Daniel. I'm going to just shut this down. Daniel is asking me, what do I think about crypto investing? Okay, I know his age from this question, right? So crypto, I was against crypto. Then I was a big crypto guy. I entered crypto big time. I promoted BTC. If you go my article, you see an article I wrote why I'm investing in Bitcoin. I don't think the point in that article have changed, but my view of Bitcoin and crypto has changed. Why? I was against crypto because crypto to me is a quote-unquote Ponzi scheme. Before you kill me, Ponzi scheme does not mean it's illegal. It just means that the new guys pay the old guys. Ponzi schemes are not illegal. It simply means the country has to make it illegal for it to be illegal. Social Security is a Ponzi scheme. But Ponzi schemes itself are not illegal. It's illegal when you are doing it, right? If you say, oh, you are making money, but you don't tell people it's a Ponzi scheme, that's the illegality of it. But it's the concept of a Ponzi scheme itself is not illegal. If I give you money and you pay my money back, fine. And I'm being very careful here. Just hear what I'm saying. No, Ponzi scheme, if the country says it's illegal, it's illegal. But the concept of the Ponzi itself is not illegal. It means new money pays old money. That's Ponzi. Social Security is a Ponzi scheme, just to make it clear. Okay, so Bitcoin and the rest are, not Bitcoin. Bitcoin has a fixed supply, but the other ones look like Ponzi schemes. So you buy those currencies, they go up in price. So who is buying? Why is the price going up? Because new people are buying. So when new people buy, I sell, I make my profit. So it's quote unquote Ponzi. I put money in, the price goes up, I get my money out. The price is going up because new people are buying. That's how I get my money out. Nothing wrong with that. The problem for Bitcoin, Ethereum, and the rest is this. They wanted to overthrow the governments of the US, the UK, of Nigeria. They said they want to replace that currency with their own currency. That's where they enter trouble. If they had left Bitcoin and the rest as just an alternative way, because Bitcoin is better than fiat. If I want to transfer money to America, I can buy Bitcoin, send the money, it gets to America instantly at lower cost. So Bitcoin should be what Africans should be using to transfer money. It's cheaper. If they left it at that, it should have gotten more adaptation. CBN might have even given them license. But they say they want to replace fiat. They call it DeFi. They want to replace fiat dollar and naira and use Bitcoin and Ethereum. No government is going to let you do that. The governments are government because they have a monopoly on money. You can guarantee that money in Nigeria. Recharge card in Nigeria is money, but it's not legal tender. A government is only called a government because it can create legal tender. What does that mean? That means Nigeria can take a piece of paper, print that piece of paper, and call that piece of paper legal tender, and it automatically has value. I can't do it. Government can do it. If you say you want to overthrow the government's ability to print legal tender, all the government will fight you. That's what they've done. So the US, Nigeria, all the governments in the world are fighting Bitcoin, and they're not going to win because you can't defeat the government. You can try, but you cannot. The government has tried to regulate them. Bitcoin says you can't regulate us. Okay, so this government has simply created their own Bitcoin. The US is going to have their own e-dollar, UK is going to have e-dollar, China is going to have e-dollar. So they will replace that the fiat with their own digital currency that will replace Bitcoin. That's what's going to happen. Like it or not, it's going to happen. If you look at the charts, the population of the world that uses Bitcoin and digital currency is very, very small. Very, very small. But they're very, very loud. So you think the whole world uses digital currency. In America here, there are ATM machines where you can buy Bitcoin. No one goes there. Pull up the data, pull it up, and say how many Americans use Bitcoin. The numbers will shock you. Just Google it. Americans use Bitcoin. But it's available. There are ATMs in America. You walk up to the ATM and you buy Bitcoin. So it's not a question of access. There's access, but Americans don't trust it. Nigerians trust it because we have to trust it. Naira is funny. To transfer money is expensive. Banks are doing guy. So to send money to America, it's faster, cheaper, and easier to do Bitcoin through P2P than going to a bank. That's why Nigerians are using Bitcoin, because it's better. E-Naira is a great product, but central bank is not selling E-Naira. E-Naira is a powerful, great product, but not selling E-Naira. So when the US dollar comes out that is E, UK euro comes out that is E, all the other guys come out that is E, the population will start to use that currency, and that's where Bitcoin will die. Because Bitcoin's advantage of digital, cheaper, faster will disappear. It will no longer have that means, that use case that it is a cheaper, you can track it. The government will say, we also have it here. So by usage, it will disappear. I saw a chart once what year was this? 2019. It was a Bloomberg. I tried to put this. Bloomberg says only 4% of Bitcoin is used for transactions. The rest is people buy it and hold because the price will go up. So if you know this about Bitcoin, that tells you that down the line, unless they get utility, so unless they get something that you use Bitcoin for, it's going to go away. Not because it's bad, not because it's fraudulent, but simply because that the government is going to give you a better product at a cheaper price. That's what's going to happen. All this, you can't track Bitcoin, wasting your time. If the government wants to track your Bitcoin, they will track it. Don't you see the US government is seizing Bitcoin from terrorists? How do they track it? Don't you see them seizing Ukraine Bitcoin? How do they track it? There is nothing on earth that is created by a human that the US cannot track, unless you created it yourself. But it's on a computer, for crying out loud. Who invented the internet? The US government. So how can you think that you send that currency on the same computer networks created by the US government? How? Come on, guys. So I'm not a geek, right? But at least I know these things. You can. So because they want to overthrow the government's going to deal with them. So maybe they should rebrand. Drop all this DeFi talk. Sell Bitcoin as a money transfer instrument, and Africans will adopt it. If Africans adopt it, it becomes a hardcore product in Africa that no government can take it away. Because if you don't do it, the central bank will allow other banks to offer. So you see GT Coin, you see Zenith E-Coin. Why would I use Bitcoin when I can use Zenith E-Coin? Because if Zenith E-Coin loses, I can go to Zenith Bank and hold them. Last time I had an argument with the Bitcoin guy, I said, who is Satoshi? This Satoshi guy, who is he? So if my Bitcoin gets missing, who do I go and hold? How do you know I'm not Satoshi? How do you guys know me, Carlo, is not Satoshi? How do you know? So because of that, you see many banks are doing their version of blockchain currency, not Bitcoin. Chase Bank is the largest bank in the US. They have Chase Coin today. It's a blockchain-enabled currency. That's what's going to happen. They will copy the good things of Bitcoin and give it a reputable name, and then they take away the use case for all these guys. So Ethereum is better because Ethereum has got some use cases. But just having a currency, that is the only advantage of Bitcoin that is a currency, that's not enough. That's not enough in my view. So I'm not saying you can't make money from it. I'm just saying long term, I don't see the future for it. So that's my answer. All right, guys, we spent, I would say, 2 hours and 30 minutes talking with you guys off here, and I love you guys. Let's go back to why we said this space, right? We're doing a financial health check. 4 boxes. You guys have got 30 days. We're going to come back here in February. You guys have got 4 boxes. Number 1 box, you want to do your active income. Number 2 box, you want to do your passive income. Number 3 box, you want to do your non-discretionary expenses, which is going to be the expense that you make without that you must make, even if you don't have money, like feeding. Number 4 box is your discretionary income. We are saying for the next 30 days, track all your income, track all your expenses. Then we'll allocate those income and expenses into these 4 boxes. When we do this, we'll also do it with our assets. Then we'll analyze it. You will do it yourself. You analyze your own investments yourself. You will see the mistakes you are making. You will see where you can save. We'll then create a cash flow budget together. You will then see how you can do it better. That's what we're going to do over the next, from now till February. But in between this time, we're going to bring our experts on the stockbroking market. Where should we invest in 2023 in Nigeria and in America? We're going to try to get folks here to come and talk to us about where we should invest and then see how we can learn. But for the next 30 days, guys, we're going to stop end of January. Then first week of February, we're going to have a space on how you can, analyze what we've gathered. So this week is expenses. Next week, I'll talk about assets. Please try to do it. It's going to help you out. I won't see it. It's going to be just you seeing it, and then we'll take it from there, guys. Remember, your goal in not what I mean in life. I'm not saying your goal is to make money, but your goal is to transit from active to passive income. When you have financial independence, is when your passive income can pay your non-discretionary expenses. When you can pay your bills from your investments, that's when you have financial independence. If you are earning a salary or you own a business and the business is paying you, that is not passive income. The business has got to pay you if you are not there. That's how it's passive income. Bill Gates owns Microsoft, but he's not there, but he's getting the money from Microsoft. If you own a business, if you're a law firm, you're the chief lawyer, if you are there to make the money, that's not passive income. But if it's your chambers and you're at the Bahamas, that's passive income. So thank you very much, guys. Thanks for the tweet and all. The gentleman, I'm going to send you the Excel sheet. So I'm going to send you the Excel sheet so we can clean it up. So I'll maybe by this time, I don't know how long it's going to take. I'll send you the Excel sheet today. He does a clean up and then we can share with you guys. So the Excel sheet is already formatted, pension, generator. We put it all in there, and it's very, very easy for you to use. And all. It has Nigerian language there, wastes, all that stuff. So you can use it to basically plan out your expenses, and it's tied in. We tied in your income to your assets to your cash flow. It's all in there. So once you put in your income, it's automatically going to calculate your expenses, your assets. It's doing that for you automatically. Just key it in, and it does everything for you. So it's easier for you. On that note, guys, I'm going to take my leave. Thank you so much. 2023 is going to be a fantastic year. And I'm going to share that idea I told you guys about, an idea for the next 10 to 15 years. Do this, and you're going to make a lot of money. So you have to start to buy the assets now to use it in the next 10 to 15 years. All right, guys, thank you so much. I'll see you guys next week, same time. Take good care, and bye.